The AI trade has gone from uber bullish to a bullish bearish combination.
View this sell-off more as an opportunity than a reason to panic.
The AI trade will continue to find support.
A lot of it then depends on the durability of AI.
If that falters, we've got a real problem on our hands.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, crude inching lower, tension simmering, the US wrapping up a second day of strikes on Iran. Just as a few Fed officials are getting the itch to hike interest rates, an equity offering from SK Hynix is more than 7 times oversubscribed. Big demand ahead of that listing.
Today is a perfect example of how deep and liquid the U.S. equity and bond markets truly are. Despite all of the worries that you're talking about, the increase in attacks in Iran, this question about inflation and the Federal Reserve possibly hiking rates, this question about persistently higher oil prices, and SK Hynix saying, even though we've had a semiconductor rout, it is a good time to go to the U.S. and raise almost $25 billion, one of the biggest outside of the U.S. Equity raisings in the United States ever. Raising a question how resilient this market is and just how wide the pool of capital is looking to invest in any part of the AI story.
To your point, it might be just short of a record for a foreign company, that equity listing, raising close to $25 billion. Look for that. On the equity side, maybe. That's where the debt still is right now. We've seen some pushback earlier this week on the debt side.
Yeah, the idea of Amazon coming to market, really seeing a bit of skepticism. A lot of people characterizing that as we weren't expecting this. This is coming with different types of protections. This is coming with a longer duration. At the same time, is it just a matter of skepticism around the overall concept, or is it just we want more money? Because ultimately what you've seen is plenty of demand just exacting a bit of higher premium to offset any potential risk. So this isn't a lack of money willing to invest. This is investors saying, you know what, we have leverage too, and we want more money. And essentially they're getting it.
Some money went back into the AI trade in the last 24 hours. Chips had a better day. I just wonder how much of that was the so-called war trade. The money going back into the things that worked the last time things really took off between Iran and the U.S.
We saw the equal weight underperform for the first time in a long time. Exactly to your point, during a period of time when the war calmed down, oil prices went down, and people were expecting disinflation to reassert itself, everyone was saying the market's going to broaden out. This is going to be a much more inclusive rally. Suddenly, the haven trade was exactly the trade that was exacting the most pain earlier, which is the semis and the hyperscalers. And that seemed to be the one performance yesterday, other than energy, was that tech trade.
Crude was inching lower. It's now inching higher, up by 0.2 on Brent crude this morning. Brent at 78, WTI at 73. I'm not sure how you would describe this current phase, this moment we're in between the US and Iran. The president gets to decide whether it's a ceasefire or not, I guess, and he says it's not a ceasefire. So you have a series of strikes. He's called them love taps in the past. I'm not sure what this is at the moment or where it's heading.
We were talking about language. Love taps, not my love language. Tiff, maybe that's also a quarrel between lovers. Let's not go there. Skirmish, the issue to me is the market is looking past this. They are saying ultimately, yes, it is raising the temperature, and yes, oil prices have to be priced higher, but it isn't in a wholesale freakout. We're not hearing people call for $120 a barrel. Maybe we're not getting the right people on to really talk about those prognostications, if you still are doing that.
We'll get them back.
Jeff Curry, please come back on. But there is a question here about how far this can go, given the sort of glut that people were predicting would reassert itself later this year if there was normalization.
Margins are so fine right now at the Federal Reserve. The difference between doing nothing and doing something is like that wide at the moment. A lot of people say this Fed is divided. Looking at those minutes, it's a difference in degree, not a difference in kind. And if you look at the inflation backdrop right now, any kind of hiccup in energy could tip things one way versus the other.
You're nailing exactly the point here, which is, was anyone on the Federal Reserve opening the door to rate cuts going forward? Or is this a hold or a hike? And that is a dramatic shift in terms of reaction function and, frankly, mentality at the FOMC, even though you potentially don't have a July rate hike on the table, and that's potentially because we don't really know. This did seem to signal that people were very concerned about a protracted inflationary push, not just coming from oil, but also from AI. So real question for next week when we get CPI, what is the threshold that really puts July into action?
Next week on Tuesday, what a morning we're going to have. Tons of bank earnings, lots of economic data. The Fed Chair Kevin Warsh speaking later that day, I believe, as well. Let's talk about the earnings. PepsiCo dropping just moments ago. Core EPS 220, the estimate 219. Lisa, just running through the detail gets your attention. The stock is up by about 1/3 of 1%.
What's fascinating to me is that Pepsi last year came out and said that it was going to cut prices. People had argued that they had been increasing prices way too much and people had stopped buying. What they did was actually see a decline in North American revenues as a result of what they had done, which was cut prices. They said they are going to persist with this because they want to increase the revenue. The revenue increased more than expected, the organic revenue, about 7%. They also had an FX tailwind. This, though, is interesting. This is the consumer. I don't know if it's discretionary. Is it discretionary to get Lay's potato chips and Pepsi Cola? Either way, it really highlights how people are still buying some of these goods, even though they had pulled back a little bit earlier this year.
Is there a World Cup commercial that David Beckham is not in right now? He's in the Lay's commercial too, isn't he?
I think so.
Right, Verizon, Home Depot.
They did hint that might be helping to perhaps bolster their earnings.
Okay, stock is up by about 0.5% this morning. Less than 1%. Equity futures up by about 0.2% following 2 days of losses on the S&P. Coming up this hour, we'll catch up with Bob Elliott of Unlimited Funds as tech mounts a comeback. Norman Roule of CSIS as the US and Iran trade attacks for a second day. And Rolf of Futurum Equities as SK Hynix attracts strong demand ahead of its US debut. We begin this hour with stocks pushing higher. Bob Elliott of Unlimited Funds writing, it's becoming increasingly clear that most AI investment will experience poor returns even if things go well. Future income growth is getting increasingly squeezed from all sides. Bob joins us now for more. Bob, good morning.
Good morning.
Is it becoming increasingly clear? And what are you looking at that's painting that picture for you?
Well, I think the basic picture of, if you look at a plan for $5 trillion of CapEx over the next 5 years or cumulatively through 2030, and you think about what sort of revenues have to come on that $5 trillion of CapEx in order to get anywhere close to a reasonable return, you're talking about, at a minimum, a few $1 trillion, right? $2, $3, $4 trillion of revenue in order to make a good return. And that is an extraordinary amount of revenue that has to happen. If you look at the hyperscalers today, what did they make in the last 12 months? $1.5 trillion. So you're talking about over the next 5 years, they're going to add on top of the $1.5 trillion, they're going to add, $3-4 trillion of additional revenue. That is an incredible amount of revenue that they have to get. Now, each one of those different hyperscalers is seeing the opportunity to be the lead, and so each one may be making a rational decision, but in aggregate, it is largely impossible that we're going to see this sort of revenue growth.
Let's build on that. The biggest source of comfort for this equity market right now is earnings. Are you saying that could be the source of risk in the years to come?
Well, I think anytime you're looking at a market, what's going to end up happening is how things come in relative to expectations. And so it's really important to look at what the expectations are right now. And right now, over the next 3 quarters, markets are expecting, or analysts are expecting, 31% annualized earnings growth on top of the extraordinary quarter in the first quarter. We're not talking about 5 years forward type earnings, although even those are at the highest level they've ever been. In 50 years, the highest level they've ever been in terms of expected earnings growth. And so you have very, very high expectations. And mostly what people are doing is penciling out what was a great quarter in the first quarter to exist not just through the end of the year, but through 2027 and out into the future. And that is a recipe for disappointment. You're already starting to see lots of cracks in the view of how productive the AI trade is going to be, how much investment is going to occur. We actually see data center growth slowing considerably. It was doubling a year ago. Today, it's growing at about 15% from the latest data. Those are the sorts of numbers that are not going to achieve 31% annualized growth rates in earnings across the entirety of the equity market.
That said, slowing is not exactly a terrible proposition considering how fast some of these have been growing. I was looking at SK Hynix and the revenue increase year over year for the first quarter. It was about 200% year over year when you take a look at just the overall revenues. I mean, if they just come in at 150% growth year over year, are people going to start crying? I mean, what is the pace of deceleration that you're expecting that really could cause some concern? Well,
in order to get trillions of dollars of revenue on all this hyperscaler investment, you need revenue growth in the AI sector to run at more than 100% a year compounded over 5 years. What are the odds that that's going to happen? Well, it's never happened in any sector at any scale in history. We're talking about cloud computing, you're talking about, back in the web days, smartphones, none of those have seen that sort of compounded type revenue growth in a sector, not to mention the fact we're talking about $4 trillion of revenue growth. That's more than 10% of GDP of the U.S. economy going to hyperscaler revenues. That is a largely implausible outcome.
So a lot of people are probably listening to this, nodding along, saying, yeah, he'll be right, but maybe in a year. And in the meantime, the music's still playing, so we're going to keep dancing. What do you do with this? Even if eventually you're right, do you act on it now?
Well, trading bubbles is a tricky proposition for anyone who's been in markets for a little bit of time has gone down the road of the early short and feeling the pain from it. And so there's sort of, I'd say, two different ways to approach this. First of all, if you're a largely long-only investor, right, the trade-off here is do you lean into this mania, or do you say, are you thankful for the gains, rebalance back, and prepare for a little tougher environment ahead? And so really it's about rebalancing. That's the most conservative way to deal with this, is to not lean in. There's all this pressure to lean in. Don't lean in, rebalance back. And wait for, there's going to be a time, and the question is, what is the spark? And sparks that pop bubbles are very, very hard to recognize on a forward-looking basis. But there will be something, maybe it's this tiff or skirmish that happens in Iran that starts to create expectations of Fed tightening, something like that. Maybe that's what drives it. But you have to be prepared that this could shift, and it could shift very, very quickly.
Well, last time, in some ways, it pushed people back into the tech trade. Do these renewed tensions create any different kind of results?
Well, I think it then comes down to what's going on, as Lisa mentioned at the outset, in the financing markets. If we get a world where the Fed is forced to engage in more tightening because this Iran trade, or because the Iran conflict starts to heat up again, we start to get inflationary pressures, the Fed really does have to be a little more restrictive. That's the sort of thing that could easily start to funnel back, right? If you can't get the debt issuance that's expected, if the equity markets aren't quite as open as people are expecting, that sort of tightening of liquidity is the thing in the financing markets that would then start to lead back in terms of what's going on in how much capex they can do, and from the capex, the earnings, and back.
A few Fed officials got the itch at the June meeting. Do you believe July is live?
Certainly. I mean, I think if you look at what's going on with oil prices, the only reason why July wasn't live was because oil prices were down basically at where they started the war. That's changed. Now, it's hard to know exactly how far this is going to go, but I think it's important to recognize from a macro fundamental perspective, the conflict in Iran and the Hormuz problem has not really been resolved. I mean, we only got ship flow through that was maybe a third at peak of what it was pre-conflict. And so what that means is we are barreling towards a loss of inventories. That's still happening. You see what's going on with the SPR, it's going down. You saw what was going on with Chinese oil imports. That was at 5 million barrels a day in June, even after the MOU was largely signed. And so this inventory drawdown is basically creating the illusion that everything's fine, and people sort of look past the political element. But if that ramps up, we're still on a knife's edge in terms of creating a loss of inventories that would create a price spike ahead in oil.
Bob, it's good to see you. Appreciate the framing, thank you. The bear case there from Bob Elliott of Unlimited Funds on the AI trade. Twos, the yield curve looks like this morning. The very front end, twos at about 420, a few weeks out, Bramo, from that Fed meeting.
Yeah, and people trying to figure out whether it's live, whether there's enough willingness to do this. I'm still thinking about what Bob said, which is you rebalance. What do you rebalance into? What isn't related to the AI trade right now? Is it European stocks? I mean, ultimately, is it vacation shares? I mean, at what point can you rebalance away from this trade?
I'll take a vacation right now. You want to take a vacation right now?
I think that, yes, sir.
Totally on board with
It'll just be bars on the screen. Sorry, guys.
We'll hear from Delta Airlines tomorrow. They'll talk lots about vacations. I'm sure there's tons of demand. Tons of demand over at Delta. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Good morning. The U.S. military striking Iran for a second straight day. U.S. Central Command saying about 90 targets were hit. The Islamic Revolutionary Guard says it struck U.S. bases in Kuwait and Bahrain and threatened to expand attacks. The Federal Reserve releasing the minutes of its June meeting, the first under Chair Kevin Warsh. A few officials saying there was a case for raising interest rates, though they ultimately supported the decision to leave them on hold. SK Hynix's U.S. listing is more than 7 times oversubscribed. Sources telling us here at Bloomberg it has attracted demand from institutional investors. According to our calculations, it's likely to be among the largest ever U.S. debuts for a foreign company. Tune into Bloomberg tomorrow at 10:30 a.m. for an interview with the SK Group chairman. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes. Up next on the programme, taking game at Iran.
We just hit them very hard. They did a little something today, but it was really retribution for last night. And when they hit, we hit back much harder.
Up next, we'll catch up with Annmarie on the ground in Ankara, Turkey, following the NATO summit, plus Norman Roule of CSIS, live from New York City this morning. Good morning. We are coming off a two-day losing streak on the S&P 500. Pretty muted, mild stuff. Haven't had a two-day stretch so far this month. Put that together just yesterday. This morning, a small bounce up by 0.2. A bounce back on tech as well, up by 0.6. It's interesting to see the tech trade. A lot of people talking about the rotation away from checks and then the war away from chips, and then the war kicks off again and people go back to chips and semis, and the tech trade picks up again.
Yeah, a real question here. Can the broadening out trade work if you have inflationary pressures persisting and potentially a live Fed? And that is ultimately the angst that you're seeing play into this market at the same time that they're saying, but tech's going to be just fine.
How live is this Fed story? Twos right now, 420. Yields coming in, 2 basis points or so. There are some people getting the itch of the Federal Reserve to hike interest rates. You could see that in a minute just yesterday. Will they act on that itch later on this month?
Yeah, some participants, according to the minutes, which were about a fifth smaller, about 1,000 words smaller in terms of this statement, fewer words.
Counting.
Yes, well, I had AI do it, so I could be wrong, but it went from some like more than 5,000 to a little more than 4,000 words. Nonetheless, people are taking a look at the potential to need to raise rates. Ultimately, it doesn't just depend on energy prices, also AI. So again, the Fed is also an AI trade.
Why would they ever 5,000 words? But anyway.
It's a great question.
Right.
But that's without footnotes. A couple other things stripped out.
Okay.
And it could be wrong because it's AI.
Okay, you double check.
I will.
Brent crude right now, 78, just about unchanged, going nowhere after a two-day rally on WTI 73.56. Under surveillance this morning, taking game at Iran.
We just hit them very hard. And I'd say we hit them 20 to 1. Every time they hit us, we're going to hit them 20. They did a little something today, but it was really retribution for last night. They hit actually 3 boats, not 2. And when they hit, we hit back much harder.
So here's the latest this morning. The US striking Iran for a second straight day. Tehran responding by targeting American sites in several Gulf nations. Annmarie joins us now from Ankara, Turkey, the site of the NATO summit that wrapped up in the last 24 hours. Annmarie, good morning.
Good morning, Jonathan. Just as the president left, mere hours after he left the NATO summit, he did what he said he, quote, was probably going to do, and that was strikes once again for a second day on Iran. CENTCOM was out with a statement saying under the commander-of-chief's direction, they wanted to degrade the capabilities of Iran to go after commercial vessels in the Strait of Hormuz. And what we've learned so far is that 90 targets were hit, and you're looking at places where there's drone and missile storage, coastal surveillance systems, air defense systems in Iran. And as you mentioned, Iran has struck back on countries like Kuwait and Bahrain that have U.S. forces and installations in the arena. It's quite difficult to understand what moment we are in right now. The president said the ceasefire is off, but then when pressed by reporters at that press conference, he said he doesn't think it's going to start again. So he didn't want to commit to all-out war, which makes it feel like we are just in the middle of a stalemate. How long can this continue where we just have skirmishes here and there with attacks on both sides? I think this stalemate potentially is the status quo the market's going to have to get used to.
Annmarie, stay close. We'll catch up with you again in the next hour. Norman Roule of CSIS writing the following. Iran appears willing to risk a renewed large-scale conflict with the United States if that is the price of forcing others to treat Hormuz as a waterway, subject to Iranian permission. Norm joins us now for more. Norm, welcome back to the programme, sir. How would you define this current phase now the president has said the ceasefire is over?
Good morning. Well, the president has basically undertaken a much broader series of attacks against Iran than our retaliation to previous Iranian strikes against shipping. It's not only meant to degrade Iran's capabilities, but it's meant to send a message that the United States is willing to expand this conflict. it's unclear and uncertain and even unlikely that this will change Iranian decision-making regarding its intent to have administrative control over the Strait of Hormuz. But it could buy us a period of an interregnum where you could have an opening for diplomacy for the Qataris and the Pakistanis to engage Iran to come up with a more stable situation.
Norm, do you get any sense that maybe the attacks that the U.S. Has done on Iran were sanctioned by the UAE and Qatar after they were attacked personally by Iran?
That is very unlikely. The United States does not seek the concurrence of other countries for its targeting packages, but the United States would coordinate with all of its partners to ensure that their defensive capabilities are appropriately aligned in case of Iranian retaliation. And we have seen Iran attack Kuwait, Bahrain, and now there are reports that there may have been an attack on a military communications facility in Doha.
At this point, what's the path forward, Norm, given the fact that ultimately the ceasefire seems to be dead, both the economic prongs related to the sanctions also torpedoed, and now you have renewed attacks? Do we have any pathway to some sort of nonviolent resolution?
Unlikely. At present, we have a situation where economic erosion within Iran continues. Iran is under severe financial strain, far more than it will admit. The administration likely believes that that is going to have some impact on Iranian decision-making. Our capability to reduce Iran's capabilities by degrading their systems is also important. But in the near term, Iran continues to see that its route is to obtain administrative control of the Strait of Hormuz and to attack those locations in the Gulf that host American bases. That's likely to be a turbulent new normal with interregnums of peace for the foreseeable future.
Norm, given how things have played out more recently, it was just the US alongside Israel. NATO members didn't come along. Given the last 24 hours and the promising meeting the president described with NATO members, do you see any reason for NATO members to participate militarily in the weeks to come?
Some NATO members have reportedly provided useful defensive capacity to Gulf states. That's going to continue. I think you're going to see some limited technologies being provided to the Gulf states for counter-drone and other activity, but the actual involvement in military operations remains unlikely, both in terms of what capacity NATO members would have to bring to this, but also the fact that they would then be directly involved in a conflict that may not have an end that they can understand or at present.
Does the same logic apply to Gulf allies?
No, because Gulf allies are stuck in the region. London and Paris are a long way from the missile and drone strikes, but Doha, Abu Dhabi, Kuwait, and Manama have to deal with this every day. But there is a much closer military integration with the GCC through our traditional NAVCENT relationship, and that relationship remains sound and excellent, based on my understanding.
They have been very restrained, given what they've faced, Norm. Do you see that changing?
They have been restrained, but there are reports that at least the UAE has conducted a limited number of military action. I don't see this changing. The Gulf states are not interested in expanding the conflict. They're not going to allow themselves to be punching bags, but they see their defensive capabilities, the U.S. response, and the diplomatic track is producing a situation that buys them the best possible sort of stability that they can hope to achieve in this environment.
Norm, it's good to see you. As always, sir, thank you. Norman Roule there of CSIS on the current trajectory for the situation in the Middle East. Described increasingly in the last day or so as a new normal. What does that new normal mean? How do you internalise that as a market participant this morning?
Key question is how much oil gets through. Ultimately, if they're agnostic about exactly how or what kind of precedent this sets for transporting goods on the seas, a real question, how much do you still have oil vessels willing to transport? And a lot of this will rely on whether the U.S. retains presence there and defends some of those ships going through the Strait of Hormuz with or without the assistance of NATO allies and allies in the region.
Oil this morning holding on to 2 days of gains, inching higher for a third, up by 0.5% on Brent at $78 a barrel. Up next, we'll catch up with Rolf of Futurum Equities as SK Hynix sees massive demand for its U.S. debut. two-day losing streak on the S&P 500. This morning, here's the bounce, up by 0.1%. On the Nasdaq 100, up by 0.6%. The story of tech, really interesting because the onset of war, the start of war back in March, concentrated reinforced bets into the chip trade, into the tech trade. And then this morning, what did we see? Once again, tech outperforming. What did we see yesterday? We saw money go back into the chip trade once again. Does this upend the broadening out? Does it upend the broadening out? We saw massive underperformance in the equal weight just yesterday. That's a question for equity investors this morning.
And it's difficult to really get your hands around because single name volatility has surged to record highs relative to the index level volatility. So this is a name specific story as much as it is an index specific story. Nonetheless, if you have inflation reasserting itself and potentially a live Federal Reserve in the face of higher energy prices, that could upend some of this rotation that people were saying, the rest of the economy finally catching up. Although at a certain point, then was the tech story really a tech sell-off, or was it just a rotation trade that got that gained a lot of steam?
A healthy rotation.
Exactly, a healthy.
Within the equity market. You know, money not going out of the equity market. It's good. It's healthy.
Yeah, it's hard for me to understand the single name volatility is healthy, considering that you're seeing it absolutely spike and that you could win or lose all your money if you're betting on specific stocks. But nonetheless, healthy, like yogurt and granola.
Yeah, nothing healthy about a situation in the Middle East right now. Low sugar granola, Brahma.
I know what that's to say. I knew I was going to get some kind of characterization there.
You know how it goes.
I know.
Let's turn to crude.
Here.
Brent and WTI. Brent crude this morning. Brent yesterday breaching 80 for the first time in almost 3 weeks. This morning back down to 78. Biggest one-day bounce we've seen since early May. Biggest two-day rally that we've seen going back to, I think, late April. So we had an 8% move over the previous 2 days. Add a little bit more weight to that, 78.50 this morning. The other part of the story we need to figure out in this market is how does this inform this? How does that, the energy story, inform what's happening in the bond market? 2s, 10s and 30s. Yields just a little bit higher in the last 24 hours. This morning down 2. But let's call this 420 again, going into this Fed meeting. And you can see in the Fed minutes, I know lots of people want to say the Fed's divided. We'll call the Fed divided, this Fed split, sure, whatever. But the margins are so fine right now that you have to wonder whether just a small movement in the energy story, just a recalibration of the outlook, just on the margin, will change things sometime soon.
And the recalibration actually is the correct way of phrasing it, because we've seen oil prices significantly higher than where they were to start the year, but not so high that they might curtail some of the consumer behavior. And that is actually the most toxic brew for a central banker that is looking at higher prices from oil, but also higher prices from AI and the other inputs that they also mentioned in the meeting minutes. That's the reason why this is actually much more palatable and actionable than, say, $120 or even $100 a barrel, because suddenly that would raise the question of stagflation. This doesn't really raise the stag part. This just raises deflation.
There's some problem with deflation, that's for sure. 2s right now, 419.53. There's been some problems with deflation for the last 5 years. As we count you down to the cash open, 3 hours away, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with a check on the memory and chip trade this morning with names like Micron and Intel building on yesterday's gains after a rough stretch for the group. And the renewed optimism is coming from SK Hynix and are reporting that the deal is over 7 times oversubscribed. The next test comes tonight when it is priced, before investors get an even clearer read on demand for the memory trade tomorrow when SK Hynix's ADRs start trading on the NASDAQ. Turning to AstraZeneca, those shares plunging 9% in the pre-market after the pharmaceutical company suffered a rare setback. One of its experimental heart drugs failed a late-stage trial, dealing a blow to what many saw as a multi-billion-dollar opportunity. But what analysts are saying is the bigger concern is that this is a hit to investor confidence, since management sounded optimistic ahead of the results. And we end on Levi Strauss. This is one of the first companies out of the gate to report earnings. Shares are falling 6%, even after it delivered a solid quarter. It delivered a beat and a raise, and it even raised its dividend. But after a strong run in the stock this year, investors were looking for an even bigger increase to its guidance, which could be an early sign of what companies are up against this early earnings season, where simply beating is not enough. John?
We've seen that movie a few times already in the last week. Yahira, thank you. That bar has reset higher, super high. going into earnings season. On our radar this morning, the US and Iran exchanging strikes for a second straight day. US Central Command saying it hit about 90 targets in Iran. The IRGC claiming it fired missiles and drones at US bases in several countries across the region. Elsewhere, minutes from the Fed's June meeting showing policymakers were split on the direction for interest rates. Fed Chair Kevin Warsh describing the meeting as a family fight, with several officials seeing a case to hike due to elevated inflation risk. And finally, SK Hynix seeing massive demand for its US listing. The memory giant's offering is more than 7 times oversubscribed, on track to raise over $24 billion, making it one of the largest ever debuts by a foreign company in the US.
Yeah, behind only Alibaba's $25 billion debut, which again points to how deep and how hungry the US market is for AI listings. Interesting to note, this comes after a massive sell-off in some of these names in South Korea. Yes, the index had been up so much that this sell-off could be considered a brief skirmish or a love tap by investors. At the same time, we are seeing an incredible amount of money being raised in the equity market, despite some of what we've seen in terms of volatility. I'll point to the why. I was taking a look at the earnings and the revenues for SK Hynix. Revenue in 2025, the first quarter, was $12.1 billion. Revenue in the first quarter of this year was $35.9 billion, and it's expected to be more than $55 billion for the second quarter. This is a massive step up, and this is what investors are trying to get a piece of.
And this is why it's had a massive, massive run over in South Korea. Mandeep Singh of Bloomberg Intelligence is standing by. He joins us now for more. Mandeep, just frame the next couple of days for us, the next 24 hours with this listing.
I mean, look, they've timed this perfectly because this is the strongest memory cycle that you can think of, in the past 30 years. And it feels like this has legs. I mean, yes, it's a cyclical industry, but there is no doubt that, the oligopoly pricing that these 3 companies have, it's going to carry that forward, in terms of top line growth. And even if, there are optimizations done at the LLM layer, nothing seems to be changing in terms of the fundamentals for these memory companies. So from that perspective, I do think, they have durability in terms of earnings. It could taper, the positive revisions may slow down, but there is no doubt the fundamentals are probably the best we have ever seen for memory.
Mandeep, some of these companies are truly world-class. When they're located abroad, though, they often look at the US market and the valuations here somewhat with envy. How much of this story is about that? Looking at valuations available in the US and doing something about it?
Yeah, look, I mean, even now within the US, these companies trade at probably the lowest multiples, even though their top line growth is insane and it may carry forward for a while, but the multiples are just the lowest. And so from that perspective, there is a narrative shift that needs to happen. And, if they can frame it as a structural change as opposed to, the industry being cyclical, that's going to go a long way in terms of the re-rating, especially around the multiples that they have fetched in the public markets.
Single-digit PEs. Mandeep, just amazing given the growth they're generating. Mandeep, thank you. Mandeep Singh there of Bloomberg Intelligence. Rolf Bulk of Futurum Equities writing, the listing is mainly about broadening US investor access and narrowing the valuation gap with Micron. SK Hynix is one of the clearest ways for investors to gain exposure to AI memory demand. Rolf, I'm pleased to say, joins us now for more. Rolf, I'm pleased you picked up on the gap between, say, Micron and SK Hynix. Can you just describe for our audience how big that gap is right now and how it could narrow in the months to come?
Yes, good morning, John, and thanks for having me. Well, as Mandeep just mentioned, there is a gap here. Currently, Micron trades at around 8 times forward earnings. Hynix is only at around 6 times, so it is a material gap, and I would not expect that gap to close in its entirety. SK Hynix remains a Korean-based company with Korean-based manufacturing, which carries an inherent risk of trade, of regulatory changes, all of these things that Micron is less exposed to as a US-based company. So I do think that there will be somewhat of a Micron premium, and that will persist. But that said, I do expect that the gap is going to close over the coming months as a result of this listing.
Rolf, does Hynix need the money, or is this going to the build out of new factories, or is this just simply stockpiling cash and trying to boost the valuation for years to come?
Yeah, Lisa, it's formally the proceeds of this IPO are going to go in their entirety to CapEx, so to the build out of new fabs. That said, SK Hynix is on a trajectory to make more than 90 billion, 90, of free cash flow. So after capex expenditures this year alone. So no, they do not need the money at all. This is probably one of the companies in semiconductors that doesn't need any funding at the moment. But it is a way for them to gain exposure to the US market, and that is how it should be perceived. And if they turn around and end up buying back an equivalent amount of shares for this listing for that amount, I think investors will be very pleased with that type of decision.
So this is a close the gap kind of moment. I do wonder, Rolf, if you do expect them to build out their capacity to build memory chips, and we've seen the Korean government get behind them to raise almost $900 billion to build more capacity. At what point does that reduce their pricing power? At what point does that increase the supply to offset the demand that's just been on fire?
Yes, this is the risk for the memory trades, that capacity build-outs of Samsung, of Micron, and of Hynix in aggregate are at some point going to catch up with this demand this buoyant demand that we have seen and that we expect to continue over the coming years. Now, the thing is with these fabs that it takes years to build out these fabs. These are complex buildings with ultra-high clean standards for the clean rooms that the equipment goes into. It takes years. There's no way to shortcut these type of build-outs. And with that in mind, I don't see any scenario in which supply is going to catch up with demand for the foreseeable future, likely until the 2030 timeframe. So yes, it is a consideration, but very much a long-term consideration at this point.
So Rolf, do you think these stocks, these names, given the PEs we just talked about, do you think they're undervalued?
Well, typically memory, as Mandeep mentioned, it is a very cyclical industry. And this is why these companies have traded on price to book rather than price to earnings in the past. It is only more recently that investors have started to think about these memory names as more traditional companies, less cyclical companies. Undoubtedly, they will remain some of the more cyclical ones in semiconductors. But we know from Micron, from the earnings of last month, that over 50% of their revenues is going to come from long-term supply agreements, which are agreements in which they lock in volume and pricing to a large degree on 3 to 5 year terms. So if 50% of your revenue is going to come from long-term agreements on which you book gross margins in the 50-60% range, then likely, yes, that should warrant a higher multiple than the 5 to X times earnings these companies currently trade on, yes.
Just incredible earnings from some of these names. Rolf, it's good to see you. Thank you, sir. Thanks for the framing. Rolf Bulk there of Futurum Equities, going into an important 24 hours for SK Hynix. With an update on news worldwide this morning, let's get to your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. PepsiCo shares inching higher. The food and beverage giant reporting second quarter earnings that beat expectations. Strong global performance and demand for its beverage lineup offsetting a revenue dip in North America. The company reaffirming its full year guidance. Meta is investing around $10 billion to build its first data center in Canada. The Alberta-based facility will have 1 gigawatt of power capacity and will run largely on natural gas-fired power. Meta plans to use the computing power for its AI models and social media apps. Volkswagen's executive board pushing a sweeping restructuring plan that could eliminate up to 100,000 jobs and close 4 German factories. Management says deep cost cuts are needed to compete with Chinese EV makers. And that's your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, the itch to hike rates.
This market has backed out all of the rate cuts.
Our call is for the Fed to keep policy on hold for the remainder of the year.
If I think about the risk to a hike, that risk is most pronounced for July.
Up next, Claudia Sahm of New Century Advisors, live from New York City. You're watching Bloomberg TV. Stocks this morning positive by a tenth, up by 0.5 on the Nasdaq. The tech trade back in fashion in the last 24 hours, thanks to this move in crude, close to the 80s on Brent. I'm only half joking. Brent crude 78.65, up by 0.8%. 2 days of strikes What is this new phase? And is this volatile back and forth the so-called new normal? And what does that mean for the supply of energy?
At this point, people are watching the flows. I don't know how they're watching them because a lot of the ships have turned off their transponders, but they're trying to gauge exactly how much oil is still shifting and how much demand from places like China has diminished so that the potential mismatch can be offset. Look, these are the questions that people have. It's a much more nuanced look than earlier this year when you saw tensions on, oil up. Oh my gosh, Armageddon. It's not that kind of feeling right now.
But you said it. Other people have as well. Persistent. The longer this persists, the bigger the problem potentially for central banks, because it just keeps nudging inflation higher or keeps it elevated at a time where it's above target and there's a massive tailwind coming from AI spending. They've got to grapple with a lot of things.
I was looking at Costco earnings that came out yesterday, and you saw that higher oil price feed into their profitability and just sort of the overall sales. It's not enough, though. It's like 2%, 3%. It's not something that people would push back against enough that would actually solve the problem. And this is the issue for central banks and the reason why the ECB is being so aggressive, potentially, at least in rhetoric, and really why there are questions in the market about whether the Fed will do the same.
How does this move in crude shape the outlook for interest rates? Switch up the board and get to the bond market. Twos this morning, yields pulling back by 2. Down 2 basis points to about 419. Let's call it 420, resetting just a little bit higher, going into a big week next week. We'll get some inflation data, and we'll hear from the Fed chair, Kevin Warsh. Under surveillance this morning, the itch to hike rates.
This market has backed out all of the rate cuts and now maybe even pricing in a rate hike.
I'm not as convinced that a hike is coming.
Our call is for the Fed to keep policy on hold for the remainder of the year.
It's really about the inflation data. If I think about the risk to a hike, that risk is most pronounced for July.
So here's the latest this morning. FOMC meeting minutes revealing several policymakers saw a case for raising interest rates, with 9 officials anticipating at least one hike this year. Fed Chair Kevin Warsh declining to submit his rate forecast. Claudia Sahm of New Century Advisors writing, "We have a low information chair, but not a low information Fed." Claudia joins us now for more. Claudia, welcome. Well framed. Appreciate that. What have we learned from a high information Federal Reserve, even if we have a low information Fed chair?
Right. So we got the minutes yesterday, and we got finally some answers, or at least some details to this question of what'll it take for the Fed to raise interest rates. The Fed's reaction function is alive and well. We had to wait 3 weeks to hear anything about it, but the minutes really did deliver on the substance of what those rate hikes would take. And they put it out in scenarios, and it very much goes back to the inflation outlook.
Claudia, that includes the AI spending, and that came up a few times in the minutes. If you just bring up the PDF and search for AI, you'll see it mentioned several times. Given the move we've just had in energy in the last 24 hours, how fine are the margins, Claudia, separating a hold from a hike? And could a renewal of tensions in the Middle East tip it one way versus the other?
Right. So the scenario for a hike is one where inflation stays elevated. And one thing that was very striking in that scenario was it did not discriminate on the source of that inflation, right? They mentioned AI, they mentioned the Middle East, they mentioned tariffs. So really, it's anything that keeps inflation high and doesn't start moving it soon to 2% would be enough to, and there was a lot of agreement. If that were to happen, most of the, or almost all of the participants said they would raise rates. So I think that's where we're just looking for, inflation to start moving back towards 2%. And you do get a sense of some impatience, like they want to see it soon. This is not like we're waiting until 2028 to see inflation moving down. So I think that's important. And it does bring the focus back to the inflation data. It's not a Fed that is divided in how we react to inflation. They're divided in what's coming next with inflation.
Claudia, are you surprised by how big a shift it was from simply dropping the easing bias to no one anticipating rate cuts anytime soon? The idea that it's not as if this committee is split between people who think that there should be rate cuts and rate hikes. The committee is split, as John was saying, between people who are going to stay on hold and hike rates. This is no one being a particular dove. Is that surprising in terms of the pace of that shift?
The events in the Middle East really were a big shift in terms of the Fed's thinking. And it's not so much that we have an energy shock. I think it's also that we have another cost shock. Last year, we had tariffs, and the Fed was very patient. We're going to look through this. We're going to wait and see it happen. And just as tariffs are rolling off, we are hit with another major cost shock to push up inflation. So the events really shifted early this spring. And I think this is a good example of the Fed can shift pretty quickly as events shift. This is very much a data-driven, this is very much a reality-driven, and you're seeing it not just at the Fed, other central banks are reacting in a similar way because it is a global shock we are reacting to.
Right now, people are pricing in about a 0.25% chance, 25% chance that there will be a rate hike at the meeting later this month for the Federal Reserve. I just wonder which side of the which camp you're in right now. The people who believe that the Fed kind of bought itself some time by having these task forces to go through some of the metrics versus a Fed that truly could be live even as soon as in a couple of weeks' time.
So the meetings are live. I think the runway to a July interest rate increase is pretty short, but by the fall, they're going to get more CPI prints. They're going to get more information on inflation, more information on events happening. So I think something would be more likely to happen in the fall in terms of a rate increase. And what was clear in the minutes, this is a Fed that is combing through the data. They're, discussing how to react to it. They're not waiting for the task forces to come back and enlighten them. They will get that information, but that's not what is kind of determining when the Fed acts next.
Claudia, you've worked at the Fed. We often talk about your experience there. Looking back, it's unusual just to hike once. Usually we're thinking about a series of hikes. Do you think under this new Fed, with new leadership, you could get a one-off hike, just a single 25 basis point move and then wait and see?
You could imagine a scenario, but it would have to do with events are shifting rapidly that would make the hike, another hike not necessary. I think, a model of something like we saw last fall where there were a series of, 25 basis point cuts to deal with downside risk to employment. You might see a flip side of that is a series of 25 basis point increases to deal with upside risk to inflation. Going one and done is unusual, but, we live in unusual times. So I don't want to take it off the table.
Claudia, it's good to see you. As always, appreciate your reaction. Claudia Sahm there of New Century Advisors, a low information chair, a slightly higher information Federal Reserve at the moment. The tell for me at the moment is just the characterization of how restrictive we are at the moment. And if you look at the minutes, very few think we are sufficiently restrictive. In fact, of the group that think we are restrictive, they say slightly. I think that is a tell. Because the question for me right now, for any Fed official, is do you believe we are sufficiently restrictive to get inflation back to target? Do you? And I'm not convinced that many people on the FOMC believe we are.
The market isn't convinced either, which is why people are pricing in a rate hike as soon as September even. When you take a look at the lower information, I was interested in the word count. So I ran a program, and evidently at the June meeting minutes, it was 4,440 words.
Okay.
Versus the April minutes, which were 5,680 words. That's stripping out footnotes and some other characterizations. But it really isn't that much less. And what I find interesting is that exactly what we heard from Claudia Sahm there. It's not a low information Fed. We are hearing quite a bit from the members. And frankly, this did point to a much more skew toward a rate hike in the not so distant future.
We're spending trillions of dollars on data centers, and this is how we're using it to count Fed statements.
I could have
Fed minutes.
Some pieces of fruit tell you this in a very lovely way.
In a cartoon.
And cartoon. And that
sure.
probably would use even more tokens. So
you could make a movie.
Yeah, I could do that by
just saying, you know what? With regards to the World Cup, we typically call it AI slop. The AI videos, like the mini movies they're making with the World Cup, the content's been pretty good.
Oh yeah, like the Norwegian guy.
Yes.
Oh my God, I literally lost about an hour and a half last night.
Right, the content's been good. Up next, David Lebovitz of JPMorgan Asset Management, General Karen Gibson of Academy Securities, Vito Sperduto of RBC, Greg Peters of PGIM.
We've had a very resilient economy.
Inflation concerns are back in play.
We've probably seen the peak in inflation for the year.
It's a sustained high core inflation with pressure for inflation to go higher.
We don't think the Fed's going to move this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores, the price action look like this. Equity futures right now in the S&P up by 1/10 following 2 days of losses on the Nasdaq, up by 0.5. Back into the tech trade. That is where the outperformance is. Yesterday and again this morning. In the bond market, 2s, 10s and 30s shaping up as follows. A reset higher in the last 24 hours at the front end of the curve. 2s back to 420, 10s close to 460. 30s close to 5.1%, setting the tone for the price action over the past few days. This move right here in crude bouncing from the high 60s to the mid 70s on WTI to 74. Brent crude a brief break of 80. Just recently, 78.76 this morning, and up by 1%.
Yeah, some people might look at this, including myself this morning when I came in and oil prices were lower, and I thought, that's crazy. It seems like things are just escalating. Why aren't prices going higher? And the answer is prices already have had their biggest two-day shift going back, depending on whether it's Brent or WTI, to either April or March. And you do have, of course, this sense that oil takers are still getting through. That said, the shift up in prices still has the Fed and the ECB squarely in play, and these are prices that are going higher. Yet another inflationary shock, as Claudia Sahm said, which is threatening the broadening out trade, but also speaking to what is a neutral rate in an economy that seems to be beset by inflation shock after inflation shock.
Forgive the pun, but this won't be smooth sailing. None of this will be. This will come with lots of...
I'm not forgiving the pun.
Okay. Lots of volatility. And for a Federal Reserve on the edge, and I don't think there's much between holding and hiking right now on this committee. This can tip things one way or the other, and that's been a theme for us so far this morning.
Yeah, and right now the market's trying to suss out how much this is a one CPI print type of event, or that the Fed could then hike rates later this month after we get CPI next week, or whether they're going to need a series of hot prints to really take action. Another key question is, does this hurt equity market valuations? Does this hurt risk assets at a time where everyone seems to be raising money and the AI trade wins if things are volatile, maybe has some chips taken off the table, but still a very robust trade? I mean, ultimately, is that enough to kill this rally?
Based on this, no. SK Hynix 7 times oversubscribed. Based on that, not yet.
You know what's fascinating? Even though we saw volatility in the Korean market, even though we saw a massive sell-off by SK Hynix and Samsung, they're coming to market with the second biggest ever debut for a foreign issuer in the U.S. for the equity market. It seems to be really well received. So even that wasn't enough to scare some investors away.
That follows a record IPO from SpaceX. That record IPO followed a monster equity capital raise from Alphabet. What was that? $85 billion. And there's more to come.
Yeah, so this market is wide open. Bigger question right now is, what is the price they're going to exact for that? Even with the U.S. Treasury yesterday selling $39 billion of 10-year notes. Well-received auction, well oversubscribed. You could talk about all those metrics. Highest yield that these 10-year notes were sold at going back to last February. So people are looking for more, but they're still willing to put their money to work.
You saw the pushback to Amazon as well, which is why the question we've asked, I think, is the right one. Are we testing the limits of demand? No. Are we testing the limits of demand at these rates, at these yields? Yeah, you've got to offer some concessions to get that supply away now. That was the pushback from fixed income so far this week.
So now people are asking, at what point will the cost be too much for some of these AI companies and, frankly, for governments to borrow? And the answer is we're not close yet. And so you can just imagine where we're going to be going forward. In other words, people are still borrowing. People are still going out there and tapping the capital markets.
More on that equity offering from SK Hynix later this hour. Equity futures right now in the S&P positive by about 0.1%. Coming up, we'll catch up with David Lebovitz of JPMorgan, with investors lining up for SK Hynix's U.S. offering. General Karen Gibson of Academy Securities with the U.S. and Iran exchanging strikes. And Vito Sperduto of RBC on what could be a record-setting year for M&A. We begin this hour with stocks rising as big tech jitters ease ahead of SK Hynix's U.S. listing. David Lebovitz of JPMorgan writing, we believe in the structural story around the adoption and implementation of AI, but recognize that the journey is unlikely to be linear. David joins us now for more. David, good morning. Good to see you.
Good morning.
How fractured is this trade right now?
So I think what you're seeing is you're seeing markets and you're seeing investors begin to differentiate between all the different pieces that go into this. You know, chips are only one piece of the puzzle. You also have to build the shell for the data center, then you have to run the data center, you have to get people to pay for the compute. And so it's not this view that, oh, you know, we love AI and we're going to buy everything that has AI associated with it. I think people are beginning to delineate a bit more between the different pieces and where there may be excess supply, where there may be robust demand, and where, to your point, you may see challenges challenges from a financing perspective to get things done at attractive prices.
Give me the split right now. Excess supply, robust demand. What's the split, the divide for you?
So I think that we're still in an environment characterized by very robust demand. I think that the risk to me around supply is primarily in the chip space and the hardware space. This is where obviously a lot of investor enthusiasm is. And, if history is any guide, when there's a lot of enthusiasm, people tend to get a little bit ahead of themselves. You can end up with too many chips, and that actually helps the people that are running the data centers because it brings down the overall cost. Where I think demand is going to remain quite robust and arguably more structural is when it comes to actually building that data center and then operating that data center, right? Again, chips are just one piece of the puzzle.
So if it's not going to be smooth sailing, maybe you should take some chips off the table. Oof, I'm so sorry. I couldn't help myself.
See?
That was,
Nice.
it's really fun. I'm enjoying this. I just wonder, at what point do you prefer equity still to bonds, given the fact that increasingly bond investors are demanding an increasing premium for the privilege of lending, for the privilege of being able to borrow money for some of these investments?
So I think when it comes to the equity versus debt question, it's really a three-part question. Do I want to own the equity? Do I want to own the investment grade bonds, or do I want to own the high yield? Because high yield is much more oriented towards the picks and shovels. And again, you can see some of the pushback on the hyperscalers. Free cash flow has gone to zero. Now they're trying to figure out how to finance this going forward. I wouldn't be surprised if we see them continue to issue equity the way that we have on occasion up until this point. For us, we find high yield credit really appealing here, not because we're going to see massive spread compression, but because effectively we can get paid around 7% with a third of the volatility of equities. When it comes to the equity side of things, a lot of enthusiasm around tech. When we watch the other parts of the market soften up and sell off, we actually view that as an opportunity, because if we're right about this whole AI productivity story, a rising tide will lift all ships, and that'll be good for the rest of the market, not just the tech, which has benefited up until this point.
Just to crystallize the point, are you seeing the pendulum start to shift away from the equity market to, say, the high yield market, to more of a fixed coupon that guarantees a certain return at a time of incredible and increasing volatility?
I do, and I think that there's also kind of the certainty, if you will. And again, they're junk bonds, and so you will see defaults at some point begin to pick up. But I think that certainty gives people comfort, and also kind of where it sits in the broader AI supply chain, right? This is what's building the data centers. This is what allows the whole thing to work. And that's very different than the debt that the hyperscalers are bringing to market. And by the way, they've already backed a lot of this high yield debt. And so you have this implicit guarantee that if things go south, you're still going to get paid. I mean, if you're an investor, that's a pretty attractive proposition, given how much U.S. equities have moved over the past couple of years.
Let's just take it back to stocks, the great rotation. Where are you and the team on the rotation now, given the restart of a conflict, a renewal of tensions between the US and Iran?
So I think that volatility is a feature and not a bug of this administration. And so, whether it's what's happening in the Middle East or whether what's happening with tariffs, right, they view volatility as a tool in their toolkit. I think that there's definitely been an interruption to the rotation here. But I think when you take a 12-month forward view, you think about what's happening in the economy. OK, we've got growth, which is pretty good. That's why we have some inflation pressure. Maybe the Fed needs to hike. Maybe they can hold. We think that they'll hold. But again, I think that we're going to need to see a few hot inflation prints before they do anything. I mean, this is one of these environments where if the Fed does feel the need to hike before the end of the year, they're arguably hiking for the right reason, right? Because growth is well supported. Inflation's a little bit hot, and they're just trying to bring balance back. And I think as investors kind of digest all of that, and as you see things hopefully settle down from a geopolitical perspective, that breathes life into the broader equity market and allows that rotation.
So does the rotation, is it independent of the rate hike debate or not?
I think it is. I think unless we were to see an inflationary environment like we did in 2022, when the Fed's sitting there and the ECB's sitting there and they're like, oh man, we really missed this one, we got to catch up really fast, that's very different than a maintenance hike. Right? A maintenance hike is saying, you know what, we feel like things are a little bit too hot. We're going to try to cool them down, not we're going to go from 0 to 5.25 over the course of a couple months.
So you don't think what we've seen over the past couple of days, which is the outperformance from tech, really persisting? You think that the path of travel for the next 6 months really is equal weight, continuing to outperform regardless of what happens with oil prices and regardless of what happens with the Federal Reserve?
Look, I think tech is going to remain well supported. Again, we view this as a structural story that's going to play out over the next 10 to 15 years, but I do think you will begin to see that rotation. I would also highlight that one of the other ways we're playing this tech story is through markets that haven't necessarily appreciated as much as the U.S. And so for us, looking to places like EM, parts of China, that's an interesting way of getting this tech exposure at a more favorable price. And I think at some point, valuations will become an issue for investors. That'll support the rotation. That'll support non-U.S. markets.
If a Fed rate hike wouldn't curtail the outperformance potentially of the equal weight, what will a rate hike actually do? will it slow inflation if it's exogenous factors that are coming in and bolstering prices?
So here's the thing about a rate hike. What the Fed is worried about is a labor market that tightens further and wage growth that reaccelerates. And I don't think we're on the cusp of that. I think the labor market is tight. I don't think the labor market is particularly strong. And so to see wage growth begin to accelerate, which is what would precipitate a series of Fed hikes, I mean, to me, that's possible, but it's not necessarily all that probable. This is going to be more to address lingering inflationary pressure from tariffs, a little bit of inflationary pressure from oil, because again, it hasn't gone back down to where it was pre-conflict, and we know the longer energy prices stay elevated, the more that price pressure broadens out into the economy. Those are things that you can manage. It's when you see that labor market begin to heat up, that's when you really have a problem.
EM equities up 19% so far year to date. Outperformed the Nasdaq and the S&P.
Yeah. EM, meaning what?
AI.
Yeah.
Let's take Hynix.
Well, I mean, that's,
right.
the question. Some people are saying if you strip out South Korea, if you strip out those names, there still is outperformance in the EM story just simply because they were ahead of the curve when it came to the rate hiking cycle, and now some of them are actually cutting rates. Also a question of which emerging markets are tied to hard assets. I was down in Brazil, and the shocking amount of resources. I mean, they have rare earth minerals that they could potentially develop. I mean, how much do you start to see some of this tapped into? Of course, there is that tricky issue of government, but whatever. I mean, these are the things that people are looking at.
These were your channel checks in Brazil, right?
I did lots of channel checks.
I have no doubt.
I did channel checks, and the monkey's very cute.
Yeah, you have a good time. Still living on it, aren't you?
I actually think that, you know, I should probably channel check again sometime soon.
Yeah, I agree with you. Maybe I'll come along for the ride.
Okay.
Just sort of check it out.
Let me tell you, it's really beautiful.
I have no doubt about it.
Copacabana is really lovely.
Good stuff. All right. David, do you get to do that over at JPMorgan? Just pick a destination and go there? Do some channel checks?
Unfortunately, not as much as I like, but I want to latch on to something that you said. You were talking about, you know, resources and rare earth minerals. The thing that I'm recognizing is that everything is becoming an AI trade. Right? Whether you're going to reap the productivity benefits of using the tools, whether you're part of the supply chain that allows the thing to come to life. I mean, AI is everywhere. And so it's how you play it, not whether or not you play it. I think that's the big question for investors going forward.
See, that was very valuable.
I appreciate it. Thank you for keeping it so serious.
That was really good.
Thank you. David Lebovitz there of JPMorgan Asset Management. With an update on news worldwide, let's get you Bloomberg Brief. Vonnie has more. Hey, Vonnie.
Hey, John. Traffic through the Strait of Hormuz coming to a near standstill after the U.S. struck Iran for a second straight day. Among larger vessels, only a U.S.-sanctioned supertanker was seen heading out of the Persian Gulf alongside an Iranian-flagged container ship. PepsiCo shares falling in the pre-market. The company's second quarter organic sales growth missing estimates. Lower prices cutting into its North American snack business. Pepsi reaffirming its full-year guidance. UK Prime Minister Keir Starmer is signalling he'll consider granting a public holiday if England wins the World Cup. The team faces Norway in Saturday's quarter-final. The final is set for July 19th, which is potentially Starmer's last full day in office before Andy Burnham succeeds him. And that is your Bloomberg Brief. John.
Vonnie, thank you. Potentially his last day in office, the day of the World Cup final. Is he going to attend? Of course he's going to attend, surely.
I mean,
if England's in the final.
Well, look, who wouldn't attend, first of all? But second of all, I mean, is he going to be rooting for Holland at a certain point? I mean, come on, like, doing the row.
Why would he root for Norway?
Because it's, I mean, Erling Haaland, the AI videos are great.
What is wrong with you, Abramowicz?
Well, he won't. I know he will. He'll vote for England. I know. Okay. He'll be like, very excited.
I'm booking the flight now. I'm out. Channel checks in the south of Italy. The latest on olive oil. How are those trees doing?
How are those lemons?
I'll bring you an exclusive report.
I can't wait.
In 2 months' time, after I wrap it up. Up next, trading fire with Iran.
We just hit them very hard. It did a little something today, but it was really retribution for last night, and when they hit, we hit back much harder.
Up next, we'll catch up with General Karen Gibson of Academy Securities, live from New York City this morning. Good morning. Equities, a small bounce this morning, up by 0.1% on the S&P 500, up by 0.4% on the Nasdaq. The Russell, some underperformance. Saw that as well yesterday. The Russell 2000 small caps just about unchanged. In the bond market, 2s, 10s and 30s. Yields settling around 420 on 2s. We're down about a basis point or two heading into jobless claims later this morning, about an hour and 15 minutes away. Setting the tone for the bond market worldwide in the last 24 hours. These moves in crude Crude up by 1% this morning, just short of $79 a barrel on Brent crude. And the surveillance this morning, trading fire with Iran.
We just hit them very hard. And I say we hit them 20 to 1. Every time they hit us, we're going to hit them 20. They did a little something today, but it was really retribution for last night. They hit actually 3 boats, not 2. And when they hit, we hit back much harder.
So here's the latest this morning. The US military striking about 90 Iranian targets in a second straight day of attacks. Tehran retaliating against American allies in the Persian Gulf, nearly halting traffic through the Strait of Hormuz. With the latest from Ankara, Turkey, following the NATO summit, Annmarie has more. Hey, Annmarie.
Hey, Jonathan, good morning. Just hours after the president left the NATO summit here in Ankara, there were another round of attacks, a second day of attacks on Iran. This is something the president did highlight and preview that probably could happen during the NATO summit. And CENTCOM came out with a statement saying that under the direction of the commander-in-chief, they wanted to degrade Iran's military capability, especially when it comes to the Strait of Hormuz, their ability to attack commercial vessels. And you can see that in the 90 targets the U.S. military went after. It's things along the coastal line when it comes to logistics and when it comes to surveillance of that Strait of Hormuz. In response, though, we have had Iranian attacks on U.S. installations in Kuwait, Bahrain, as Norman Roule mentioned in the last hour, more reporting about U.S. military capabilities as well in Doha. The big question is, where does this leave the truce that they stuck with, that MOU? The president said earlier yesterday that the ceasefire was over. Then he was pressed by reporters if we were returning to an all-out war as he made his way back to Washington, D.C., and he said he doesn't think so, he doesn't know, but if it was a war that we would win. So now we're left with a situation where the ceasefire has certainly been tested, actually broken. It's not an all-out war, but it's certainly not peace. And that's potentially the stalemate that the world and the market needs to get used to.
Annmarie, from the market's perspective, it is very easy to look at this as an almost comical story. The back and forth with no resolution. We have strikes and then maybe we back off a little bit. We claim that we've had a call. You forget just how serious this moment is. And the threat level against the safety of the president is in mind as well. And he alluded to that in the news conference just yesterday. Annmarie, not lost on many reporters right now is that the president arrived on one plane in Ankara and left on a different one. Are we finding out why and what happened?
Yeah, the president said yesterday in the press conference he's enemy number one. He was continuously pressed by reporters in the press conference and as well when he finally got to that new Air Force One in the United Kingdom. Why was this change of plane, especially since he went over to Turkey in the new Air Force One that was a gift from the Qatari government? There's more reporting coming out that this was at the request of the Secret Service because it doesn't have all the defense capabilities, and they thought that it would be safer to take the old plane to the United Kingdom and then make the switch there. So a lot of questions about this. When the president was very not forthright, though, about this. He was saying how he wanted to just show off the new plane to the U.S. troops. But clearly this was more than that. This seemed to be a security issue. And to your point, Jonathan, it wasn't just once. The president has alluded to a number of times over the past 24 hours that he is on the target list for the Iranians. This dates back also to Trump 1.0 after the killing of Qasem Soleimani. And the president and the Secret Service felt there was this needed precaution to keep him safe.
Annmarie, with the latest in Ankara. Annmarie, thank you. This from the New York Times this morning, that people briefed on the new plane's capabilities, who spoke on the condition of anonymity to discuss sensitive security issues, said the new plane does not have all the features of the older plane.
Yeah, it was stripped out entirely, and I think it cost something like $1 billion to retrofit with all of the features. Still working through exactly and making sure that all of them are secure to guarantee safe passage.
That's the latest from Ankara. Let's build on this conversation with General Karen Gibson of Academy Securities, writing, when President Trump says the ceasefire is over, it is a political and potentially operational signal that he may no longer be committed to using restraint when employing military force. General Gibson joins us now for more. General, welcome back to the programme. What do you think that means for the next few months?
Well, I think this is very reminiscent, obviously, of the tit-for-tat strikes and counterstrikes that we went through in late June. At essence, at core, I think it is a difference of opinion, a difference of interpretation between how the U.S. and Iran are viewing the rules that we agreed to in the MOU supposedly for the transit of vessels through the Strait of Hormuz. There are many other areas of potential conflict in the MOU. This is just one that we'll have to work through. The Iranians are insistent that they will control the transit of vessels through the Strait. And of course, that's something that we staunchly oppose. And I see very little room for overlap between these differing viewpoints between Iran and the United States. I don't see a speedy resolution of this essential difference.
General, in the meantime, a real question about what the U.S. will do to ensure that oil tankers can continue to pass through the Strait of Hormuz. Do you have a sense of what the U.S.'s appetite will be to protect non-Iranian crude tankers that are trying to traverse the Strait?
I think the United States is probably prepared to do that. Certainly, it's a capability that we have, and the decision to do so would be a political decision. The U.S. Navy has that ability, and in fact, has been assisting some of these vessels with their transit through the Omanian side of the strait. The question is really, though, to what extent can we protect against vast numbers of drones and missiles, shore-launched missiles that are difficult to detect, that are very agile, and that provide a very minimal warning before they are fired.
General, the troop presence that we currently have, that the United States currently has in the region, how much do you expect that to be sustained at the level that it currently is at for the foreseeable future, as a result to what Norm Roule was saying is the new normal going forward?
Yes. So I think the heaviest burden, obviously, is on the naval forces and the Air Force. And some of the vessels have been there for some time, rotating through those vessels. It's also a very heavy lift on intelligence, surveillance, and reconnaissance aircraft, and the various sensors that we have for detecting threats, because that's really a very heavy lift in protecting commercial vessels that would be, as well as our own forces and our own bases that would be transiting through there. Not such a heavy lift for our ground forces. We do have ground forces deployed there, but they are obviously less engaged in this.
General.
We've been engaged in much longer conflicts in the Middle East before, but it really is a heavy burden on the Navy and the Air Force.
Don't apologise. We appreciate your time. Thank you from us, as always. General Karen Gibson there of Academy Securities on the latest situation. That map tells the story really right now. This is what the fight is over, for the Iranians at least. They have a very specific path in mind that they want ships to take, and it's right by the coast of Iran and not of Oman, and they want to charge a toll. That's what the battle is over at the moment.
And right now, the United States and a lot of allies are saying that that is an unsustainable solution, that a toll will not be something that can become the status quo. So you get this stalemate, and clearly it has fizzled in terms of the memorandum of understanding. That memorandum of understanding has broken down, and it is unclear if there is a path to bring it back. So if this is the new normal, is it going to be who is going to help protect that other corridor near the coast of Oman to avoid any kind of attacks coming from the Iranian forces?
And based on the experience of the past few days, that's very difficult to do, given the attacks on ships that we have seen, of the ships that have tried to go around the coast of Oman. Brent crude this morning, 79 at the moment, WTI around 74. Up next, we'll catch up with Vito Sperduto of RBC on what could be a record-setting year for M&A. Plus, Yahira has your morning movers. Memory stocks rising ahead of SK Hynix's US debut. Micron up 4% from New York City this morning. You're watching Bloomberg TV. The up and about 2 hours away, equity futures on the S&P 500 shaping up as follows. On the S&P, following 2 days of losses, a bounce of about 0.1%. Money going back into the tech trade in the last 24 hours. The Nasdaq higher again by 0.6%. Thanks to the war, because of the war, to some extent, maybe, yeah.
Look, it's a very difficult thing to exactly nail down. Nonetheless, this is the playbook. When people start to get worried about higher oil prices, suddenly inflationary pressures, central banks back in action, they say, well, tech won't be affected, so why don't we go into tech? This is added by the fact that we've already seen a sell-off, so people might be going back into it at a time where it seems like the demand isn't going away, and it just seems to be expanding out to more players.
Turn to the bond market. Twos this morning, down a single basis point. Some data 60 minutes away. The 2-year around 4.20. Yields resetting just a bit higher at the front end of the curve. Informed by this move in crude. 2 days of gains on oil. You can make it 3 up by 0.8. Brent crude just short of 79, 78.69. And maybe on the margin, changing the outlook for interest rates just a little bit.
Yeah, and partly because they are not surging that much more. We're not talking about $120 Brent crude, and the fact that it isn't rising more means that there isn't going to be the demand destruction. People will absorb this. That is going to be an inflationary pressure that can persist without necessarily curtailing demand. Again, we talked about it earlier. It's the stagflation without the stag, which is just inflation, and that's the reason why the Fed officials are worried.
Crude this morning up 1%. As we count you down to the opening bell, a few hours away, let's get to your morning movers. Some single names. Yahara has more. Hey, Yahara.
Hi, John. As you all said, the memory and chip trade is back on this morning with names like Micron and Intel building on yesterday's gains after a rough stretch for the group. And the fresh optimism is being injected by SK Hynix in our latest reporting here at Bloomberg that the U.S. listing is more than 7 times oversubscribed. The next test comes tonight when the deal is priced before its ADR starts trading on the NASDAQ tomorrow. Meanwhile, we are seeing Salesforce shares under pressure, down 4.3% after one Wall Street analyst poured cold water over its AI ambitions. KeyBank downgraded the stock to sector weight, saying customer checks show little signs that Agentforce, its flagship AI platform, is showing meaningful traction. The analysts say that any boost from AI could be further away than thought, if it even comes at all. And we end on PepsiCo. Shares are barely down, just 1% in the pre-market. But this is an interesting story because this is a company that slashed prices earlier this year to try and win back consumers. And while its earnings show some signs that it is gaining traction, it definitely came at a cost, weighing on revenue in its North American business. John?
Yahara, thank you. Thanks for the update. One more stock, Meta. In the pre-market, down by about 1.7% this morning. This from Reuters just moments ago that Meta plans to start manufacturing an artificial intelligence chip from September as part of its plan to boost overall computing power to 14 gigawatts next year. Showed an internal memo reviewed by Reuters, the lead paragraph from them this morning.
Yeah, codenamed Iris to specifically cater to their needs. It just points to how Meta is trying to expand into some hyperscaler-like features. I mean, we were talking about earlier them selling some compute capacity. Now talking about mimicking what you see from the likes of Amazon or even Google trying to manufacture their own chips. At what point is Meta saying our business model doesn't make sense with the amount of spend that we're doing unless we also have hyperscaler-like activities? Again, watch the space to justify the spend that people have pushed back.
It's been a confusing month, that's for sure.
I am very confused.
Neo cloud firm on the side, maybe in the future.
I think I need to do some channel checks.
Meta down by 2%. What does that involve? Trips to Virginia? Check out some data centers?
I think that it's going to Bali. I think that Bali is going to have a really good...
data centers in Bali.
Big business.
New, huge. I'm sure management will be convinced. On our radar this morning, the US launching fresh retaliatory strikes against Iran for a second straight day.
We just hit them very hard, and every time they hit us, we're going to hit them 20. They hit actually 3 boats, not 2. And when they hit, we hit back much harder.
Traffic through the Strait of Hormuz grinding to a near standstill as President Donald Trump says the ceasefire is over. Elsewhere, SpaceX, xAI, unveiling its latest chatbot, Grok 4.5, to the general public in a competitive bid against Anthropic and OpenAI. The model was built in partnership with AI coding startup Cursor, CEO Elon Musk calling it a faster, lower-cost Opus-class model. And finally, SK Hynix seeing a strong investor demand ahead of its US debut. Sources telling us here at Bloomberg the listing is more than 7 times oversubscribed, set to raise nearly $25 billion, ranking it among the largest foreign debuts in the US.
Yeah, and the conversation we were having earlier about why they're coming to market I found really interesting. And you nailed it about Micron and the idea that Micron has a multiple that is so much higher than SK Hynix. And SK Hynix is saying, well, we could do that too. We just need to list in the US and have access to this market. And to some degree, that is the sole purpose. It shows how much demand there is and how much the image of memory chip manufacturers has changed, going from a cyclical business to one that is structural with a lot of locked-in contracts that are multi-year, as well as just overwhelming demand that has given them a premium that really hasn't been seen historically. And clearly, they're able to tap into that even at a time of volatility in the Korean market.
And given the amount of supply we're seeing elsewhere as well, which we've talked about endlessly. Let's turn to M&A. 2026 shaping up to be a record year. According to data compiled by Bloomberg, global transactions exceeded $2.5 trillion in the first half. The surge putting deal makers on course to pass the record haul set back in 2021. Vito Sperduto of RBC writing M&A is at a historic halfway point, and it is broadening out beyond the mega caps. The engine is strategic, not speculative. Vito joins us now for more. Vito, good morning. Good to see you.
Great to be back.
That last line is really important. Strategic, not speculative. Can you just sort of build that out for us?
Yeah, I think it builds on the theme we've always talked about, which is, good strategic M&A gets done. And if you're thinking about the long term, that's where the benefit is. And so what we're seeing is, you've talked about the fact that the market has been broadening. Year to date, I think we're seeing, depending on the sources you look at, globally, M&A is up 42%. On the back of being up 40% last year. But in the U.S., it's even more magnified. It's up about 69% through the first half and up over 50% last year. But what's been interesting, and since I was last here, we were talking about the first quarter where there was a clear divide between the large cap and the smaller cap. And so if you looked at it, it was really driven by these large cap transactions in the first quarter. And it was especially clear in the U.S., where you saw deals over $5 billion were up 200% in Q1. Obviously it's a 3-month sample set. But deals below $1 billion were down 14%. You go 3 months later and through the first half now, we're seeing large cap still driving it, up 128%. But the reality is it's a broader participation now, and we're seeing deals below $1 billion up 22%, and that's just with 3 incremental months. So what that tells us is that the larger players, the larger corporates, have considered their significant strategic opportunities. They've either executed on them or they've moved on. And now they're thinking about what else can I do to add on. You're also, the other thing that's on the sideline is, private equity hasn't really been as big of a participant year to date or last year as they have historically. But on the corporate side, we are seeing them pursue smaller transactions. We are seeing a plethora of sell sides preparing to access the market in the second half of this year. And I think, we're obviously talked about in the last half hour a lot of what's going on from an external noise perspective, and maybe I'm belittling it. But I think the corporates especially have gotten very resilient in this environment. They've seen an MOU in place. They've seen it pulled back. They certainly are concerned on the geopolitical front, but they're also seeing methodologies to play through it.
You track confidence levels. How high is C-suite confidence right now?
So when I was here last, we had the first quarter measure where it was up to 59 on a scale of 100. So it was above the 50 neutral point. So CEOs felt pretty confident about the forward outlook, and they thought there was going to be a good level of activity going forward in their businesses, in their sectors, and so forth. We saw that drop in the second quarter and down to 47, and the key difference being the start of the Iran conflict. And so the CEOs were all of a sudden pulling back a little bit, but it was still pretty close to neutral. They identified geopolitical concerns as their leading concern. Their second largest concern was sort of AI and the impact on their businesses going forward. But from a geopolitical perspective, the concern is not so much where are oil prices or what's going through the straits. It's what is it going to cause in terms of inflation going forward? Is it going to cause inflation higher for longer, just like rates higher for longer? And is it going to make it more difficult for me to operate my business? And so I think we're seeing a lot of resilience on the part of the C-suite, and they're playing through this, and I expect that to be the case. But it is certainly, they're watching the headlines just as much as anybody.
Has that curtailed the full year outlook for total M&A?
I would say it's not changed my view on it. I always thought going into this year we were going to have a record year in the U.S., and we're not. I still feel that pretty strongly. I think it's difficult to get to the record year we had globally in 21, where you had such a broad geographic participation. And so just to put that in perspective, you keep in mind that last year, the second half was the real acceleration, right? When we've been together, we've talked about that last year in the first half. I think everybody was trying to get their arms around the market, around this new administration, and we had talked about it taking at least 6 months. And then you saw the second half incredibly accelerate, and that's what drove the volumes last year. So I think the comparison to last year is going to be difficult in the second half. The first half of this year is roughly equivalent to what we did in the second half of last year. And in the U.S. market, we will see volumes exceed 21. I'm pretty confident of that. I think globally we're not going to see that, but it's going to come pretty close. And it's certainly going to be above last year. But the other piece we're seeing is that technology has always led the way, and it continues to. But right now, and I noticed that in the graphic you put up, you talked about excluding the SpaceX transaction as an example, right? The reality is, even without that, you're seeing an incredible market out there. And so technology, that sector is still greater than the next two sectors combined, which are healthcare and energy and utility.
Are you seeing the financing window not close, but start to get a little bit more exacting, a little bit more expensive, a little bit more discerning?
There is some incremental risk being priced into it as they're trying to fund it. And you talked about Meta and Amazon, and they're sort of moving towards hyperscalers. I'd argue they're hyperscalers today, right? And if you look at the financing that they've gone into the market with, and right now, obviously from the headlines, Amazon's in the market with a large debt capital markets transaction. If you consider since last November with this transaction, they'll have raised over $100 billion of capital in the debt capital markets. Maybe that's gotten slightly more expensive right now, but there's still appetite for it. And I think people are just adjusting to the current rate environment, and they're figuring that out. The other piece, which we haven't mentioned, is the equity capital markets are on a tear. And our heads of equity capital markets put out a piece last week where they had to adjust the headline. They were originally saying this is the best market since 21, and now it's become the best market ever, right? And I thought that was a clever way to put it, because even excluding the SpaceX transaction, you've still got such a large participation. And the reality is the industrial sector, if you take out SpaceX, is the largest participant in the IPO market this year.
As you look across asset rent, you look at, say, debt and equity at the moment, if I had to raise capital, I know it's super simplistic to ask this question this way, but is it easier to raise equity capital than through the debt market at the moment?
It depends on who you are, and it depends on what your forward outlook and story is, just like anything else. I think the investment grade community is seeing a fairly ample debt financing capacity out there, and they're taking advantage of it. And we're seeing that across the board. You're seeing it for M&A purposes, and you're seeing it for general purposes as well. I think from an equity perspective, what I'm watching closely is what is the broader participation in the IPO market? Because I mentioned the private equity community and the largest amount of assets that they've ever had in history in their portfolios. They're watching closely how much this IPO market opens up and how much it becomes a realistic exit alternative for them. And not necessarily that they're going to tap it, but even if they're going for a sale, having a realistic public market alternative creates that competitive tension. So that's one of the areas we're watching closely. And we actually expect industrials and consumer and retail, for example, to be big participants in the second half of the year.
Vito, it's good to see you.
Thank you for having me.
Thank you, sir. Appreciate it. Vito Sperduto there of RBC. Let's give you an update on news worldwide with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John. Thank you. Meta preparing to start manufacturing its own AI chips. Reuters reporting the Iris chip will begin production in September. The move is part of Meta's plan to double its compute capacity to 14 gigawatts in 2027. The developer behind an evacuated New York City high-rise says he'll reconstruct 15 upper floors after identifying under-reinforced columns that caused part of the converted apartment building to sag. The Department of Buildings says the structure is stable. An investigation into the cause of the issues is ongoing. Wimbledon's semi-finals are set. Germany's Alexander Zverev defeating American Taylor Fritz in straight sets to advance. He'll face hedge fund scion Arthur Ferry. On the women's side, Linda Noskova and Marta Kostyuk made it through to the next round. And that is your Bloomberg Brief. John.
Bonnie, thank you. Thanks for the update. Up next, a family divided.
What will be interesting is how much of a read we get or don't get into that closed-door family fight. We don't think the Fed's going to move this year.
Sounded like local news then, didn't it?
It did. I was
right?
a family
Up
fight.
next,
I was like, a family divided.
A family divided.
Yeah.
Roll the package.
I was about to say.
Yeah. Is it really divided when 9 of them want to raise rates, though?
It started with a meat packing.
There's like that much between them right now. Some want to hold, some want to hike. Greg Peters of PGIM joins us next, live from New York City. You're watching Bloomberg TV. Equity futures positive by 0.2% on the S&P 500, on the Nasdaq higher by 0.8. Under surveillance this morning. Got to do this again. A family divided.
What will be interesting is how much of a read we get or don't get into that closed-door family fight that Chair Warsh keeps talking about. We don't think the Fed's going to move this year. I think it is this sort of getting used to the discomfort of less transparency.
Governor Powell left behind at Chicago Airport.
Yeah.
It's the start of Home Alone, right? Right? Here's the latest this morning. Let's move on. Minutes from the Fed's June meeting showing increasing inflation concerns, with half of the policymakers seeing a case for a rate hike and the other half supporting keeping them unchanged. Greg Peters of PGIM writing the following. Our base case scenario is one where continued growth momentum supports nominal growth and the Fed hikes rates in 26. Greg joins us now for more. Greg, welcome, buddy. Good to see you. How close do you think we are to those higher interest rates from this Federal Reserve?
I think we're pretty close. I think what's most important is the shift, right? If you just take our own forecast as an example, a couple of weeks before Warsh stepped up to the podium, we moved from 2 cuts this year to 3 hikes. And I think that directional shift is really what matters here. And so we can debate whether they start in July or not at all. But I think that vibe shift is really what the market is feeling and should be feeling. I personally think they're pretty close. I think, the minutes kind of help cement that, at least in my view. And I feel like they're vigilant around inflation. I think that's what central banks are supposed to do.
It's been a problem, though, for a number of years, Greg. What's the catalyst for the vibe shift? You alluded to it a little bit. Just build on it if you can. What's the catalyst for that massive shift at this Fed?
Well, I think there was possibly a misread of Warsh himself, that he would be dovish and just do the bidding for the president. And he came out quite strongly that, inflation fighting is what matters. And that's all he focused on. And make no mistake, we're well above the 2% bound here. So it makes sense to me. And, they have to get credibility back to a degree. And I think focusing on inflation is a way to do that, because they're far away from that 2% level.
Greg, initially when we saw the new FOMC's tone, the yield curve flattened. There was a sense that the Fed would have a greater chance of hiking rates, and that actually brought down the long end. Recently, that's changed it. And actually, you've seen a yield curve steepening reassert itself. In other words, even as you've seen that 2-year fixed around 420, you've seen the long end yields rise. Do you think that that's something that's going to persist? Do you think that that's signal, or do you think that's noise?
I think it is a signal. What I think the yield curve reflected was that the surprise, let's call it surprise, that Warsh came in much more vigilant around inflation, and that kind of pushed down the back end of the curve. That was a pretty big move. I think we've settled into a more kind of rational place, but I think the pressure over time will be for the curve to steepen. Do I think it's a here and now necessarily? No. But do I think, over the next quarters, years, I think the pressure will be for steeper curves, not flatter curves, just because, I've heard you guys talk about it in the past, just the unrelenting supply that you're seeing not only out of the kind of AI ecosystem hyperscaler space, but let's not forget, you have a lot of sovereign debt that needs to be, financed here over the next, several years or so, and that'll put pressure as well. And all those factors, I think, will contribute to higher yields, not lower yields.
Has that changed your view on long duration bonds or even medium duration bonds, given the fact that increasingly you have seen yields rise, the supply seems to be unrelenting, and inflationary pressures seem to be persistent, even with the prospect of tightening by central banks?
No, it hasn't changed my view. It's been a frustrated view more than anything else. So, my view all along, our view at PGIM has been, this supply is interest rate insensitive, right? You think about the hyperscalers as an example. They're playing a different game. They don't really care if it's 50 basis points, 100 basis points, you name it, higher in yields or spreads. They are going to finance what they are going to finance. Federal governments, same issue. They have to come to market regardless. And I think that puts pressure just on yields and particularly the back end as debt sustainability, mania, bubbles, all those factors start to come into play, at least into the conversation. So, so I think this is the beginning, not the end. And I think you'll see this pressure on long end yields. So I think that is a persistent story. But if you look at yields in the belly and further in, I think that is where we're most excited because the yields are high. It does roll down. You're not taking excessive duration or spread duration risk. And so I think it's a very different place in the middle to the front of the curve versus the back end of the curve.
Well, let's sit on the back end. Long bonds at 5. What kind of number, Greg, do you think we could look at in the next 12 months?
I could see that kind of steadily rising. I think 5.5 is quite good. What you're seeing now, what's capping yields in the back end is the yield itself. So what's really interesting is that, as soon as yields kind of move above 5 and like investment grade 30-year corporates are, close to 6, investors get really excited. But as the longer this persists, I think the more investors will adjust to that not maybe being enough. And so it takes time, right? And so I think this is a early innings of this revisitation, revaluation of what attractive means, just given the supply. And so, I can see, U.S. Treasuries and, 30-year corporates, moving higher here pretty substantially.
Interesting. Greg, thank you. Greg Peters there of PGIM Fixed Income. It's not alone. I've heard it a few times. If you look at the offering from Amazon earlier this week, that's pushing AI-related debt offerings. Lisa mentioned the number earlier this week to around $335 billion so far this year. What's that, double last year? The debt coming from Treasury is not going to end. That supply is going to keep coming. That competition for capital will lead to higher interest rates.
Yeah, and what Greg was pointing to there, the one thing that's been capping yields is the yield itself. And people get excited about it because they haven't seen it for a number of years, but they'll get less excited as that yield continues to climb and they might be able to get more. And we saw a perfect example of that yesterday with the $39 billion of 10-year notes auctioned. Because yes, there was plenty of demand and people actually pushed back on my observation about how high the yield was and said, talk about how well the auction went. It went really, really well. But the yield was the highest going back to February 2025.
Back. What's wrong with these people, Bramo?
Oh, people are absolutely allowed to. Please push back, and I'll push back again.
Questioning the Bramo. Up next, Michelle Weaver of Morgan Stanley, Syth of Raymond James, Nela Richardson of ADP, Matt Stucky of Northwestern Mutual. The third hour of Bloomberg Surveillance just around the corner.
The AI trade has gone from uber bullish to a bullish bearish combination.
View this sell-off more as an opportunity than a reason to panic.
The AI trade will continue to find support.
A lot of it then depends on the durability of AI.
If that falters, we've got a real problem on our hands.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Equity futures on the S&P recovering a touch. We're up by a few tenths of 1%. A bounce back again on the NASDAQ, up by 0.75%. The money going back into tech in the last day or so. In the bond market, 2s, 10s and 30s, 2s around 420. Yields a little lower on the session, down 2 basis points, 30 minutes away from jobless claims. Setting the tone for this market in the last few days, this move in crude. 2 days of gains. Can you make it day 3? Up by 0.8% on Brent, just short of 79.
We already have had a pretty substantial move, which is the reason why you're not seeing a bigger move today, considering the fact that tensions only seem to be escalating. Another round of strikes by the United States on Iran overnight. One notable thing, though, is that we're not talking about how that could potentially upend the risk asset market. Increasingly, the risk asset market has moved on, not because they are ignoring it, but because they have sort of accepted that it does inject a little bit more inflation, but it doesn't upend the idea of what we're seeing in AI or potentially even consumer spending.
Does chaos in the Middle East, is it bullish for tech stocks? Is that what we're saying? Is that the trade of the last 24 hours?
You know, that was the trade earlier this year, that even if you didn't see a broadening out in the rest of the economy because of high oil prices, you do get that AI secular trend that will give that a boost. That said, it's not clear right now. I mean, yes, you are seeing that in the price action today and yesterday, but what we just heard from David Lebovitz, he came on and he said, look, I actually still think the broadening out trade is going to withstand and outperform simply because these are the companies that are going to benefit disproportionately going forward, regardless of whether inflation is just a touch higher.
Underperformance on small caps, underperformance on the equal weight dominating the session through Wednesday. Into Thursday, equities up by 0.2% on the S&P. Coming up this hour, we'll catch up with Michelle Weaver of Morgan Stanley, with stocks finding a firmer footing. Syth of Raymond James downgrading Delta Airlines ahead of earnings. And Matt Stucky of Northwestern Mutual, with SK Hynix's equity offering receiving some big demand. We begin this hour with stocks pushing higher as tech bounces back. Michelle Weaver of Morgan Stanley writing, investor positioning in semiconductors has become extreme. The sell-off can be viewed through the context of our house call for a broadening in performance. Michelle joins us now for more. Michelle, good morning.
Good morning. Thanks for having me.
Good to see you. Does this move in oil upend that broadening story?
No, I think whenever you have these periods of geopolitical instability, you always have to go back to the fundamentals. The fundamentals have to remain your North Star. And the fact of the matter remains, we're still in a really strong earnings environment for U.S. stocks. We saw the average stock in the Russell 3000, so just the typical small company, up 10% year over year in the first quarter. That's the strongest earnings growth they've seen since 2021. And you'd really need to see oil above $100, $120 for a sustained period for me to start getting more nervous on some of that broadening out call where that becomes a problem for input costs for companies.
We saw a massive quarter as well for the chip players. They had fantastic earnings. They saw fantastic gains. Why is the money going to drift away from that story a little bit more?
So I really think a lot of it comes down to positioning. And I want to be clear, I am not calling into question at all the longer-term AI theme. I think the longer-term AI theme is very much intact. But after you saw that incredible run post-last earnings season, you had very, very high positioning, very high exposure within the semiconductors names. So I think now you're just seeing some of that natural repositioning, rebalancing as you head into earnings season, as you want to start trimming some of your risks there. But overall, the AI theme is still intact.
Is it healthy to see so much volatility in single name stocks, even as you see the overall index kind of remain fairly stable in the face of a whole bunch of different shocks?
I mean, I'm not surprised by the volatility, just given all the headline risks. So we're hearing all this. People are rotating under the surface. Now we've seen money moving back into tech because that theme is so durable, and I think people are a little bit more comfortable there. But overall, I'm not surprised by the volatility we're seeing, just given all the concern around oil, given concern around inflation, given the concern that this raises for consumers. But I think it's not surprising.
There's also an issue going forward with earnings as they trickle out about what kind of profit margin we could see from some of the consumer-facing companies. We did see profit margins expand, even as consumers didn't feel really good about inflation.
Yeah.
In fact, they feel pretty terrible about it. They really hate it. Right now, you're seeing the likes of Pepsi come out. They cut prices last year. That's reduced some of their revenue in certain parts. Do you expect the same, that increasingly consumer pushback is going to crimp margins, or do you think that that kind of margin expansion can continue?
I think it's a risk for companies that have more exposure to the middle to lower end consumer, because we're still seeing the K economy very firmly in place in the U.S. If I think back to where we were heading into the year, we'd hope that inflation was going to start to cool down. Unfortunately, given the moves in oil, that effectively acts as a regressive tax on the lower income consumer. And so lower income consumers are still very much stressed. We do run our own proprietary consumer survey, though, and we're seeing an improvement in sentiment. It's not outright positive, but people are becoming less negative than they had been a few months ago. So the consumer's in an okay place. I'm not seeing anything terribly concerning around credit cards or auto delinquencies, but they're in a middling place right now.
How relevant is sentiment to the equity market story? I think the way people feel is important, but to the equity market story, is it relevant?
I think it's important to keep an eye on, especially as we go throughout the year. If you have negative sentiment for an extended period, I'll start to get more concerned. But overall, we've seen people continuing to spend through this. They're not happy, but the spending has continued to hold up. Maybe they're going to push back more on prices, but they are still going to go out and spend and get what they need.
Cue the Federal Reserve. Does it step in and hike interest rates, and what does it mean for your call?
So our economists do not think that the Fed are going to hike this year. They think they're going to remain on hold for the balance of the year. I think, yes, there are renewed concerns now around oil prices and inflation. But if I think back to last week, we got a softer payrolls number. And as we saw in the FOMC minutes that came out yesterday, the majority of the members are comfortable with remaining on hold for the rest of the year.
How much would a rate hike actually materially change your view, though?
One, I don't think would have a huge change on it. Overall, though, we do need rates to remain contained. But I think, one hike, that's not going to completely change the story.
There's also been a theme that's increasingly prevalent in our conversations with different analysts, which is, are we in an earnings bubble? Forget the evaluation, forget the AI, but are we overestimating how much earnings can continue to expand? We're getting a taste of that when it comes to a couple of companies. Samsung reported earnings, fantastic earnings, punished. We saw that again today, overnight, just on the margins with Levi Strauss. What's your sense of this being kind of the sort of foretelling, the foreshadowing leaves for what's to come?
Yeah, I mean, overall, I think earnings are still very much powering the story. We're coming off of a multi-year earnings recession for the average stock. That's really what's driving that call for a broadening out. We'd seen a lot of the market being powered by the AI infrastructure names. And while we're still very positive on the overall AI thematic, I do think you're going to start to see some broadening in performance as you see those companies continue to do very well on earnings. Earnings revisions breadth is still surging. I do think that is supportive for the market. I don't think, we're going to see all these earnings beats and the market is just going to look the other way and sell the news.
This market has reset expectations higher, is what you're getting at, Bramo.
Thank you. Yes,
not just on those two names. I mean,
true.
So much higher going into this quarter.
We've gotten used to double-digit earnings growth and then some. And the idea that we were speaking about with Bob Elliott, he was saying that we're pricing in more than 100% growth in some of these hyperscalers and some of these tech names over the next 5 years, every single year. Is that plausible? Is that possible? And that is potentially where some of the disappointments could come.
Michelle, where are the beats going to come from? Now we have reset the bar so much higher. Coming into this year, that's been the surprise, a positive earnings shock. How do you shock a market twice?
So, I mean, I wouldn't say it's been priced in throughout the market, though. It's been priced into some of those semiconductors names, and that's why positioning got so outsized. But I wouldn't say that it's been priced in throughout the market. It's really that large cap tech that had been driving things higher. But now I think there is still a lot of room and a lot of capacity for those positive earnings revisions and for hopefully what we'll see a very strong earnings quarter to come through and be priced into the broader part of the market.
Favorite sector right now?
I really like biotech. I think that's an interesting sector.
How come?
It is very beneficial from M&A. You had the story on earlier. We're seeing very, very strong M&A. I also think it's a very interesting play on AI adoption. So I think that it's one of the sectors where you can really see improvement in both the product as well as the efficiency. We're seeing a lot happening within AI-enabled drug discovery. So I think biotech right now is a really interesting play on both the M&A theme as well as the AI adoption theme.
Interesting. Michelle, thank you. Appreciate it.
Thank
Michelle
you.
Weaver there of Morgan Stanley, heading into earnings season, which officially kicks off next week, which I don't really understand because it started, and down to report in 24 hours.
Yeah, which is the ultimate kickoff. But really, JPMorgan is like, no, it doesn't start until we start.
Do they say that or do we say that?
I mean, I think that we've bought into it.
Why do we buy into it?
I don't know, but we do. We always say it starts
ridiculous.
next week, even though it's already started. I mean, we were getting
for the
some
big
today.
banks next week.
I mean, yeah, but whatever.
Okay.
Can I just say,
sure, please.
I can get behind the biotech trade. If they can cure cancer with AI, I'm all there. I'm very excited about that.
Yeah, everybody else.
I mean, honestly, like that is...
On board with you.
I spend time researching just where the developments are, and some of the most difficult ones. I think it's wonderful.
That is worth the data centres, without a doubt.
Much more so.
I don't think that is an original take, though, Bramo. I think a lot of people are on board with that idea.
Thank you.
All right.
I'm glad that I've got a vote of confidence.
Let's get you an update on stories worldwide this morning. Everything else you say is original, truly. Contrarian. Your Bloomberg Brief with Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Maine Democrat Graham Plattner says he's suspending his campaign for a U.S. Senate seat. The announcement coming after he lost support from several Democrats following a sexual assault allegation, which he denies. SK Hynix's U.S. listing is more than 7 times oversubscribed. According to Bloomberg's calculations, it's likely to be among the largest ever U.S. debuts for a foreign company. And tune in tomorrow at 10:30 a.m. for an interview with the SK Group chairman right here on Bloomberg. Russell Investments being acquired by a group of investors led by the venture firm B Capital and CalPERS. Sources telling us here at Bloomberg the deal is valued at $2.8 billion. It's aimed at getting the 90-year-old asset manager, Russell Investments, ready for the AI era. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie later this hour. Up next, the morning calls plus savvy Syth of Raymond James downgrading Delta Airlines ahead of the earnings report in the next 24 hours. That conversation up next.
If you look at the hyperscalers today, what did they make in the last 12 months? $1.5 trillion. So you're talking about over the next 5 years, they're going to add, $3-4 trillion of additional revenue. That is an incredible amount of revenue that they have to get. In aggregate, it is largely impossible that we're going to see this sort of revenue.
That was Bob Elliott of Unlimited Funds, the high bar for earnings expectations. This is something that Liz Ann Sellers of Charles Schwab questioned. Just the idea that maybe this time the bubble might be in the earnings and not in the price. Ramo, it's something you mentioned just moments ago. That's very unlike what we saw, say, 25 years plus ago when we had the tech bubble.
Yeah, this is what maybe we're seeing on the margins, not necessarily with the tech names, although Samsung is a great example of that. Came out with very good earnings report. Their stocks tanked because of overall sentiment, but also the likes of Levi Strauss. Have we baked in good news, even though we haven't necessarily seen the proof yet?
So we've had some pushback. It's notable, Levi's being one, Samsung a much bigger story, Micron's margin's a problem for everyone else, all these kind of things coming together. Then you've just got the normal stuff, the bread and butter. How's the consumer doing? Can they tolerate higher prices? What's the read on PepsiCo this morning? Is that a tell of what we might see this quarter?
So last year, Pepsi said that it was going to cut prices on some of its products by about 15% after they'd been accused of raising prices much beyond what the average consumer could afford, the basket of goods getting too high. What they did see was a 2% decline in its revenue in its North America business. And they talked about how consumers are pushing back as a result of inflation. The CEO saying results were tempered in the quarter as U.S. food and beverage category performance moderated with consumer budgets tightening due to rising inflationary pressures. Is this a concern for particular brands that cater to lower and middle income consumers, or is this something that can be a more widespread phenomenon where you start to see on the margins consumer pushback?
The latest from PepsiCo this morning. Here's the latest price action. A bounce up by 0.2 on the S&P, on the Nasdaq 100 up by 0.85%. A better story for tech in the last 24 hours, just as people talk about a rotation away from chips. The money goes back to chips because of this move in crude. Brent and WTI this morning pushing higher by 0.4% on Brent, $78 on WTI at about 73. Just briefly yesterday breaching $80 a barrel on Brent for the first time in 2 or 3 weeks. A 2-day rally on Brent could become day 3. Just a small gain so far this morning. That set the tone for this bond market. 2s, 10s and 30s. In about 14 minutes time we'll get the data. We'll get some jobless claims. Jobless claims have done nothing for a long, long time. The data that has started to move, ISM this week, a bit softer than expected. Jobs last week, a bit softer than expected. Will you see that in more data at a time when this Fed is actively considering higher interest rates? And 2s, that yield is still well north of where the policy rate is right now.
Yeah, another way of asking this is when will the labor market matter again? Because right now it's not mattering at all to the Federal Reserve because it seems to be stable. Do you get a peak perking up in some of the numbers, the wrong kind of perking up of the initial jobless claims that could potentially put it back in focus given the fact that we have seen a weakening? Or are we just seeing volatility in data that has been highly volatile?
It would be shocking to see higher claims, wouldn't it? Like materially higher claims, because claims have done nothing for so long.
This is a non-event at this point. I think it is fair to say that it is not on the radar for so many different people. We have not spent any time talking about this. This used to be the key real-time indicator of the labor market, and currently it seems to have flatlined.
The previous week was 215 initial jobless claims. The estimate in our survey, 217. Let's see what we get in about 13 minutes' time. Let's get you some morning calls. First up, Bank of America adding Meta to its US 1 list, joining the firm's best investment ideas. Her stock is down this morning by close to 4%. Your second call from William Blair, initiating coverage on AMD with a market perform rating, saying it's well positioned to benefit from the AI boom. That stock is up by 3.6%. And your third and final call from JPMorgan, cutting its price target on Exxon to 158, seeing limited upside ahead with its revised valuation. That stock is down by 0.6%. Let's talk about the earnings. We mentioned Delta a few times this morning, kicking off airline earnings before the bell tomorrow. Syth of Raymond James downgrading the stock, writing, quote, "We continue to view Delta as a top pick for long-term investors. However, following the recent run-up in shares, somewhat narrower near-term upside valuation prompts our rating change from strong buy to outperform." Savvy joins us now for more. Savvy, welcome to the programme. It's good to see you again. Let's talk about what you are expecting to hear, to see from this company going into the weekend.
Thanks for having me, John. I think it's from a demands perspective and from a pricing perspective, I think the message is going to be quite positive. It's the one kind of silver lining in the backdrop of all of this kind of fuel pressure the airlines have been facing, is that especially in the backdrop of last year when demand got hit from all the policy uncertainty, airlines have seen some really good fare increases, levels that you really haven't seen in past years, in being able to pass through higher fares and have them stick, and see very little kind of demand pushback from passengers. So I think the revenue side of the story is going to be positive, and I think all eyes will be how sustainable that is.
How do you get a sense of that, Savvy, when there's so many different moving pieces that are real time? I mean, isn't this just sort of something exogenous that's going to be a market-wide story that they can't really predict?
The one thing, Lisa, that airlines do have in their control is capacity. And that's where you've seen some very proactive moves. Now, we have unfortunately had Spirit that had gone away. That's taken about 1 to 2 points of capacity out of the system. But beyond that, the industry as a whole is keeping capacity flat. And if you look at demand, it usually grows 1 to 2 times GDP. And given the strong economy, we are kind of undersupplying the market, and that's helping keep those average fares moving higher. So that is the kind of the key here from an executive standpoint. I think that given the level of uncertainty, there's going to be a lot of caution in adding back any capacity and trying to control the situation as much as they can. And I would say on the other side, at least fuel has come down from the heady levels we saw earlier this year.
We talk about JPMorgan when they come out with earnings, and that supposedly is the kickoff of earnings season, even though it really is Delta coming out tomorrow. And we say, is this a bank story or is this an overall economy story? And Delta, I think we can ask the same question. Does this give an indication of traveler appetite and of the broader airline story and the economic story, or is this a Delta story, which is catering to a higher end consumer that has the capacity to spend and to travel much more so than in other places?
That's a fair point. It is going to be a consumer story overall, but it is, if you look at airlines, they are kind of medium to high income household exposure, and Delta kind of maybe, and some of the legacy carriers a little bit higher end of that. So it is a consumer story. It is the consumer that has really held up airline revenue, and corporate as well, actually, because corporates have come back in a very big way this year after really being conservative last year in reaction to all the kind of the policy changes that you've had, or the policy uncertainty that you've had. Look, there are Delta specific stories here. They have very kind of unique revenue and margin opportunities than some of their peers. But overall, I think tomorrow it will be a story of the consumer and the economy.
When we talk about technology and we talk about the banking sector, a lot of the focus this earnings season is going to be on the CapEx. We've heard a lot of discussion around CapEx. When it comes to the airlines and Delta specifically, how focused are you on CapEx when it comes to new planes, when it comes to the supply of them, as well as the increasing prices for the components given some of the supply chain constraints?
Yeah, that's really important. Like, what I would say about Delta is they have kind of over the past 10 to 20 years kind of approached CapEx in a more stable manner. In the past, in this industry, you'd have these boom and bust, and you still have some Delta peers that have these very kind of high capex years and very low capex years, Delta's made a point to be a lot more consistent in capex and having a balance sheet and a profit profile where they can continue to invest year in and year out without having to kind of take capex down. So we expect very steady capex story from Delta. You know, the component cost, that's definitely an issue for the industry. That flows more through OpEx for the industry. And again, much like fuel or any other cost, they really have to, you know, use strong demand and or capacity adjustments to try and pass that through.
If you asked people to guess right now which stock in the airline business was outperforming out of Delta, American and United, I think you'd guess accurately across all three. You'd say Delta was the highest, not far behind would be United, America would be lagging. That's been the story so far the year, up 26% on Delta, United up by 13, American up by close to 8. It's kind of changing over the last month, though, Savvy. American Airlines is starting to do something. What are they getting right at the moment?
Yeah, I think what you've seen there is Americans really trying to turn earnings around, and it really depends on which time period you're looking at here. If you look quarter to, you know, the second quarter, American had significant increase in their shares, and the reason for this is their earnings are a lot more volatile. So in high fuel prices, I think people feel a lot worse about American. They have a high leverage. But if fuel is no longer concerned, they are doing some of the right things to really turn around that story, and that becomes the focus. So it really depends on kind of the macro environment and where the shares go.
Savvy, it's good to see you. As always, thank you. Savvy Syth there of Raymond James, heading into earnings from Delta. Have you seen Delta's new basic business?
I have heard about it. Okay. I've read about it, but I haven't seen it.
Do you know the trade-offs? These are the trade-offs. If you want a lower fare to fly premium, first class and business, these are the trade-offs. Seats assigned after check-in, trade-off number 1. Fewer earned miles, trade-off number 2. Reduced checked bag allowances, number 3. No complimentary or paid upgrades, no same-day confirmed or standby changes, and fees for changes or cancellations.
And no access to the Delta One Lounge. That's another aspect of this as well.
Is that one too?
I believe so. I believe that is also no access, but you get a lie flat bed for a much lower price. And so how many people are saying, look, if I'm going to be traveling overseas, I want to get there and be okay, I'm willing to pay for the lie flat bed without all of these add-ons potentially. You know, interesting how they're trying to segment out every single person and their specific need and their specific price point. That, I think, it might be the path of travel.
I'm going to do my channel checks in a moment, see what the fare difference will be.
You're going to do your channel checks, and then you're going to execute to see exactly how you're going to feel.
To tell people the experience of what it was like.
Yeah, and meanwhile, Ryanair is saying, yeah, we're going to pay you to go, you know, you're going to have to pay us to go to the bathroom.
Like one of those digital packages, Bramo, of me peering through the window of the Delta One Lounge. I can't get in. I can't get in. And then fly business to Brazil.
To Rio de Janeiro. You can go on the beach of Copacabana.
Sure. Up next on the programme, breaking jobless claims. We'll get reaction with Nela Richardson of ADP from New York City. You're watching Bloomberg TV. The up and about 60 minutes away. Equity futures this morning on the S&P firmer by 0.3%, picking up here as we get closer to the cash open. On the Nasdaq this morning, higher by 0.9. Jobless claims seconds away in the bond market heading into it. The scores look like this: 2s, 10s and 30s. Yields on 2s down 3 basis points to 4.19, setting the tone for that this move in crude higher. Yesterday and the day previous to that. This morning up again for a third consecutive day, up by 0.7%. Guess what jobless claims came in at? Mike McKee has the number. Hey, Mike.
17K. Well, John, the foolish consistency of little minds is back again. 215,000 jobless claims were filed last week. That's almost exactly the same as the week before, revised up to 217,000. Continuing claims, 1,814,000. That is just a tiny bit higher than 1,806,000 the week before on a revised basis. So basically, the Fed has told us in the minutes that they are sort of certain that the labor market is relatively steady at this point. It is inflation that worries them, and the jobless claims keep that a worry front and center in the sense that there doesn't seem to be a problem in the labor market at the
Mike, from now on, I think you can just record the hit ahead of time, maybe the day before, and we'll just play it out at 8:30 Eastern Time on a Thursday morning. Before you go, I prefer to do it live. Let's talk about this Federal Reserve. In the minutes, Mike, what was your takeaway? What do you think it implies about what might happen at the next meeting in a few weeks' time?
Well, I think basically what they told us at the time, and remember that was the day that the memorandum of understanding was signed with Iran, was that they expected or they thought that we were going to see inflation perhaps start to diminish as the year went on. And that meant they would probably leave rates where they were, not cut rates, but because they wanted to bring us closer to the 2% target. Now you've got Groundhog Day again with Iran. So I think the takeaway is that they're going to be still focused on inflation, and maybe the odds of rate increase because of inflation go up. We'll obviously be watching on Tuesday for CPI, not only for services, which they're worried about, but now we got to add AI to all the concerns in terms of CPI.
You could see that, Mike, all the way through the minutes as well. The contribution from the spend to higher prices in America. This headline just dropped just moments ago that Micron is reporting up to $3 billion in investment for US semiconductors. Mike, we're seeing it all over the place. Hundreds of billions of dollars of capital being raised and invested into this story. Mike, that money that's being raised, a lot of people come on the program and say it's rate insensitive, that these companies are going to do this whatever the interest rate is. They're going to spend and invest regardless. How does the Fed handle that?
I don't think the Fed worries about it in that sense, because at this point, what we're talking about is a 25 basis point move, maybe 50 basis points. That doesn't even take us back to where we were a year ago. So the Fed is able to think about what's going to happen a year from now. The biggest thing about what you were just saying is that all that money is being raised, but it's not being spent all at once. It's going to be spent over a period of time. And the problem is there's a shortage of equipment, both electronic and construction, to fulfill all these data center promises. And so that would suggest that this inflation is going to be sticky going forward. So they're going to probably be looking at inflation as a concern well into 2027.
Mike McKee with the latest. Michael, thank you. Looking ahead to inflation data next Tuesday. Next week, July 14th, is ridiculous. Almost every single big bank on Wall Street reports earnings that morning. We'll get CPI, and later in the day, I believe we'll hear from Kevin Walsh, the Fed chair. So next week is like one day, it's Tuesday, then go to the beach and take the rest of the week off, because a lot's going to happen next week on Tuesday.
I think there are some other companies reporting earnings that are very upset and feeling very hurt right now, John, because they are reporting
Morgan Stanley on the Wednesday.
Yep,
stick around for Morgan Stanley, and anyone else who might be offended and reporting earnings, stick around for them too.
Look, it will be really important, and we will get a sense on all the major themes on Tuesday, not only their earnings from the big banks, but also their CapEx plans on tech, because that's actually been an increasing story. And then Kevin Walsh, does he come out and just talk about something that he saw out the window that day, or does he actually give guidance about how he sees inflation? This Micron story is interesting because the $3 billion is going into plants that can produce semiconductors in the United States. At the same time, the SK Hynix is raising money to build plants to build memory chips over in Korea. The capacity output has to increase to meet demand, and everyone's raising money to do that.
To meet tons of demand. Micron up by 6% in the pre-market right now. What do you do with claims 215?
Absolutely
what do you do? Should we just stop talking about it? Stop reporting the number?
Well, right now it seems like the Fed has stopped reporting the number. They have stopped talking about it because they are not looking at the labor market, because it is flatlined in terms of not necessarily non-existing, but just in terms of the number changing. I think that's interesting.
As I'm saying that, Nela Richardson of ADP alongside me just going, no, we've got to talk about claims.
I am itching to jump in right now.
I'm sorry. I hope I've not offended you as well. What do I do with claims 215?
I'm going to give you a fresh take.
Please.
Okay. So we've had enormous stability in jobless claims, but the health of the labor market is how it's treating new entrants. So let's go there. If you look at very early career, I wrote a blog this week about teenage unemployment. It's the highest unemployment rate we've seen outside the pandemic period in the last decade. It's around 14.5, 14.6%. It's harder for these inexperienced workers to get a job. And then I'd like to push back to those who are trying to get into this labor market, those who have been unemployed unemployed for 27 weeks or more, above 20%, 27% now. We haven't seen this level in 4 years, going all the way back to the pandemic recovery. It's hard to enter this labor market as an inexperienced worker, and it's hard to get back into this labor market. And that's what we're seeing. It's not just the layoffs, it's the roll-offs. I think that's what you're going to see, because one thing about being unemployed and getting unemployment insurance is that you have to be active in looking. If you give up, you're no longer counted as part of that active and looking that leads into the unemployment rate. And the longer and higher we see these long-term unemployed, the more likely we're going to see that discouraged worker share go up. And so this is the cost of a very stagnant labor market. This low hire, low fire labor market has a cost, and it's a cost we don't see because these people aren't in the labor market.
To your point, you don't see it because when you see a 4.2% unemployment rate, it would imply this labour market's quite tight.
Right.
How would you characterise it?
I think it's quite still. And we've talked about this before, there's just not a lot going on. There's not a lot of dynamism. Some of this is because of demographics. People are leaving early. Maybe they got their retirement boom already, their house price boom already, and they're ready to leave. There's plenty of other stuff to do besides work in this economy. Maybe it's just that they just never found their footing in this labor market because the turnover is so low, those opportunities are so uneven, they're not opening up in the same pace, and they've given up. And so we have to look at this, we can't look at this initial jobs number in isolation. If you pack on the other data, what we see is a labor market that's not very inviting to those on the outside.
Is it wonderful, though, on the inside? I mean, I'm asking because are the people who actually are employed getting more effective, getting more efficient, and getting paid a lot more and seeing wage increases at a faster clip?
You know, at ADP Research, we've been writing a lot about how there's very little turnover, that workers are kind of staying put. Some would say stuck. Some would say happy. There's a lot to be happy about in this labor market. If you already have a job, you have stable wages, that's great. You may have some hybrid work from home, that's great. But there might not be a lot of upward mobility because we're not seeing the churn. So it's a mixed market. But if you're happy where you are, you're likely to stay happy because the wage growth has been fairly robust.
You know, I want to go back to where you began about youth unemployment, or the idea that teens are having a harder time getting a job. Is this an issue of the jobs not being available, or is this an issue of the jobs they want not being available, that they get out of college and they want to go to an office and push some paper around rather than say, I'm sorry, go become a plumber or an electrician or build a data center?
I don't know if they want to go to an office at all, Bramo. For some of them.
True. Stay home and push papers and feed their pets. I'm just seriously curious about whether it's the skills mismatch here.
Well, when I talk about early career, I'm talking about the earliest. I remember my summer job as a 16-year-old at a pizza place with irregular hours, irregular pay, but lots of cool points because I could feed my friends free food. Then I went to a library with really predictable hours and pay, and the economist in me loved that more. But we're not even seeing that. We're not even seeing the retail sector or the leisure or hospitality sector take very young workers and teach them about the labor market. There are things that you can only learn through experience. And even a 16, 18, 19-year-old gains from being invited into a summer hire. We're not seeing it in the same levels. And then you get to slightly older workers, those who are in college, who may be home for the summer. Again, unemployment is higher for them now than we've seen in the last few years. And then you get to the college grads, and we already know, we've told that story, that it is harder to enter into this labor market. So our early career trajectory is stagnating along with this low hire, low fire labor market. It's something we should talk about more and not dismiss when we think about the health of the labor market.
I washed dishes and refined my Italian speaking skills.
There you
really
go.
got a deep understanding of cursing in Italian. Right?
And the necessary suds.
And an unappreciated skill in the labor market, for sure.
Without a doubt. You should see how fast I am at home now, just clearing the kitchen.
You know what? If you need to practice, I think we got a sink full if you want to come practice.
I'll give that a miss. I'll practice cursing, though. Commercial breaks, we can do that if you want.
I've heard that, actually.
No?
Yes,
Nela, thank you. Appreciate it. Nela Richardson of ADP. Let's get you an update on stories worldwide. Let's get your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, we're recapping the data we just got. Jobless claims coming in at 215,000 last week, slightly lower than the estimated number of 217,000. Continuing claims for the week in line with expectations, coming in at 1.81 million. SpaceX AI launching its latest chatbot, Grok 4.5, to the general public. Elon Musk's company calling it the company's most intelligent offering to date. It's designed for coding and agentic tasks. Micron shares are higher. The memory giant announcing it'll invest up to $3 billion for U.S. semiconductors in an effort to bolster the supply chain stateside, including $500 million in financing support for Taiwanese chipmaker Global Wafers facility in Texas. And that is your Bloomberg Brief. John.
Bonnie, thank you. Thanks for the update. Appreciate it. Up next on the programme, we'll set you up for the day and the week ahead. Plus, we'll touch base with Matt Stucky of Northwestern Mutual, seeing long-term opportunities in AI as SK Hynix gears up to join the NASDAQ.
When we watch the other parts of the market soften up and sell off, we actually view that as an opportunity, because if we're right about this whole AI productivity story, a rising tide will lift all ships, and that'll be good for the rest of the market, not just the tech, which has benefited up until this point.
That was David Lebovitz of JPMorgan Asset Management weighing in on the tech trade and the equity market. Your equity market doing better, up 0.25% on the S&P, up by close to 1 percentage point on the NASDAQ as we head towards the open, about 45 minutes away. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing Meta shares falling in the pre-market, down 3.3% on this reporting from Reuters that the company plans to begin production of its first in-house AI chip in September. This could eventually lower Meta's computing costs, but it puts the focus squarely back into how much this company is spending on AI infrastructure. So this is a very different message from our reporting last week that Meta is planning to monetize that infrastructure through a cloud business, and it is a very different stock market reaction. While Meta is under pressure, some of the companies helping it build that chip are seeing gains. Broadcom is up 3.8% in the pre-market. It is helping design the chip, while TSMC, which will help manufacture it, is also higher. We are also seeing SanDisk rise 5.4% as Reuters reports that it secured a long-term supply agreement with Meta in flash storage. And on the other side, we are seeing shares of IBM and Microsoft falling in the pre-market on our reporting that Starbucks is looking to build more of its own software using AI. And so it's developing tools that could eventually replace some of the software that it buys from both of these companies. John?
Yahira, thank you. Thanks for this morning. Looking ahead to the day ahead and the week ahead, check it out. In the next day or so, we should hear about SK Hynix ADR pricing. They'll start trading tomorrow. Look out for that. Plus, we'll get numbers from Delta. And then it's Tuesday. Look at this for a headline act. Check it out. JPMorgan, Bank of America, Wells Fargo, Goldman Sachs, Citi, all reporting earnings on the same morning. After we wrap up all of that, we'll get CPI data at 8:30 Eastern Time. And then later on that morning, Fed Chair Kevin Walsh testifying on Capitol Hill, squeezing all of that into just a few hours.
If you want a fire hose, here it is. And key question is, how thematic will some of these threads be? Inflation, number one. Geopolitical risk, number two. Strength of consumer is number three. And then, of course, the Fed's reaction function really plays into all of those things. Will Kevin Walsh give any sense of that? I do think that the big banks are going to be important, though, to give a sense of the corporate confidence going forward as well, as we were speaking about with Vito Sperduto.
Of the three, how would you rank them of importance for you as you think about Tuesday? What's more important?
I would say earnings. I think earnings, absolutely, because right now CPI is potentially volatile as a result of a number of different characteristics, although another data point to potentially go into the FOMC's meeting. And I don't expect Kevin Walsh to say anything. Ultimately, I think that he's going to be pressured by a whole host of people, and he's going to stick to his script. That's forward guidance. I'm not going to provide that to you. Ultimately, we're looking at all things, but we're going to bring inflation down. Inflation's a priority. People will freak out. He'll say inflation's a priority. We have some disinflationary aspects.
You write the script for him.
I mean, how do you get around actually saying anything that could potentially?
That's how I'd stack it too, by the way.
Yeah.
I think everything goes downstream from the banks. The banks are going to be financing all this investment. All this investment will generate inflation. There's your CPI. next in the order. And then the Fed's got to respond to all of that, because a lot of this right now is out of their hands. Even with rates where they are, a lot of this is out of their hands.
And Kevin Warsh, in some ways, is saying, over to you, markets. Let's figure out what you think is going to be the way, the path of travel, and we're going to look at you as one of our indicators.
Let's look to Micron. Let's look to Micron as some of the investment we're seeing right now. Micron up by more than 6%, climbing high this morning. The company pledging up to $3 billion to strengthen the U.S. semiconductor supply chain. Ed Ludlow tracking a story for us. Ed, what's your reaction to that? Number's not massive. What's your response?
The number's not massive, but every memory chip starts with a silicon wafer, and silicon wafers take a very long time and lots of money to get right on the yield side. So $3 billion, $500 million specifically, is going to Global Wafers, a supplier of silicon wafers. I would also point out, for size and scope, like Micron this week made a $250 million contribution to the Trump Accounts initiative. So this is a company that's committed to spend around $200 billion over time to onshore its supply chain and build its own capacity in the United States. The reaction in the stock is interesting. That is a big number and a big move. But we've talked endlessly about the pressure memory names have been under, and maybe it's more in the context of SK. That this is kind of getting now some trade and some enthusiasm.
So, Ed, just build on that. SK, Hynix is coming out with a big debt offering, equity offering rather, tapping the equity market.
Yeah.
ADR's listing here in America. What's behind that move?
Yeah, so like on the face of it, you go, okay, they're going to raise about $24 to $28 billion, depending on where we net out. They need to build out capacity. But there's been a sort of valuation gap. They've traded at a discount to their peers, which are Micron and Samsung. Around the world, portfolio managers would love to have more access to Korean technology and Korean names, and they can't for various reasons. So that's a psychological part of it. And SK, it's about 57–60% of the high bandwidth memory market. So every time we're talking about the crunch and supply crunch in HBM chips, SK is at the heart of that AI story. That's one reason that the market's paying attention. I've learned a really interesting lesson of late, including with SpaceX, John, which is like the headline is 7 times oversubscribed in terms of demand. I would think about it more in a dollar basis, right? If you're doing 7x a $28 billion deal, that's a big dollar number. And that probably gives you a sense of the attitude and enthusiasm towards it.
Ed, thank you, buddy. As always, Ed Ludlow on Bloomberg Tech in a few hours' time. Look out for that. And don't miss Ed's interview with the SK Hynix chairman tomorrow at 10:30 Eastern time, as we're having that conversation about those numbers coming out of Micron. Just to put a line on it, $250 billion through 2035. They've raised their planned US investments to more than $250 billion. And that is up from a previous number of, I believe, $200 billion, Bramo. So that is a big number.
Yeah, and talking about how this investment will support their goal of producing 40% of their DRAM in the United States. So taking those Taiwanese companies' prowess, understanding, intelligence, bringing it to factories in the United States to have domestic production facilities.
This is the take from Matt Stucky of Northwestern Mutual, writing, AI demand remains strong and continues to support long-term growth opportunities. Matt joins us now for more. Matt, welcome. How strong is the demand for some of these offerings to invest all of this money in this theme?
Well, I mean, I think you talked about, just briefly about how oversubscribed SK's ADR listing is going to be. But, I think also you look at these companies' capital allocation plans. We talked about Micron spending $250 billion, upping that from $200. Just, a few weeks ago, we talked about how SK Hynix and Samsung, issued out their capital budgets, and that level at about $512 billion was 50% above analyst estimates. And so not only are investors excited about the future, but these companies themselves are putting their money where their mouth is in terms of expanding their capacity to meet the demand of the moment.
Do you think, Matt, rate increases would make a difference to these investment numbers?
Not at a 25 or 50 basis point level, Jonathan. I think in terms of the roadmap that these companies are having, it is kind of more of a secular view. And while, a policy rate increase is a headwind to a little bit of the financing costs, it's not, hugely material for these companies when credit spreads are as tight as what they are. However, with hyperscalers tapping the debt markets and the equity markets for capital, it does make it more capital market sensitive just by nature. And so, that fragility lens, in terms of how you're financing these things is higher versus just financing it through operating cash flows. But an incremental move by a policymaker, 25 or 50 basis points as is priced in the forward curve is unlikely to really materially deter these plans.
How actively, Matt, are you switching from one company, one loved tech name to another? Because it seems like there's been a lot of rotation within the space, not only semiconductors and hyperscalers, but also within names themselves. I'm thinking of the semi rally that has left NVIDIA cold. I mean, they suddenly have been left behind. At what point do you try to play some of the divergences that you see in markets?
By nature, we're longer term investors, and so our turnover is probably less than the other managers that are out there. We've had exposure to, not directly to the Microns of the world, but the companies around that ecosystem that sell directly to the Microns of the world. So the semi-cap equipment players have been long-term holds of ours, and we continue to like those names. And we like the NVIDIAs of the world. Our most recent move has been, though, to increase diversification, though. And this is separate from what we've been discussing in terms of the semiconductor space, but to kind of increase diversification through kind of some inflation sensitive asset classes. So we recently increased our REIT allocation as an example. So we're longer term nature in our thinking that kind of reduces turnover, but we're also looking to achieve higher levels of diversification in our portfolios today.
Matt, good to see you. It always is. Thank you, sir. Matt Stucky there of Northwestern Mutual. These numbers aren't getting smaller, are they? In many places, they're getting bigger.
The idea that Micron went from a $200 billion plan investment to $250 billion plan investment, the fact that SK Hynix is being given a green light to raise even more money in U.S. equity and potentially even debt markets as a result of the demand for their IPOs, for their equity sale, gives you a sense of how much appetite there still is.
The story's not changing, but the price of the story is. It's getting more costlier to make some of these investments in certain places. Which is why some of these guys are doing what they're doing, right? Because there's so much demand and prices are increasing by so much, they can build out this capacity.
There are a couple of different things happening here. On one hand, SK Hynix wants to build out capacity because of how much demand there is for the memory chips. How much is the Micron effort to move production to places like Idaho really being driven also by a number of policy shifts in the United States, as well as just around the world to make supply chains more domestic, more resilient?
Nasdaq futures this morning up by 0.9. Coming up tomorrow, we'll catch up with George Goncalves of MUFG, Lisa Shallard of Morgan Stanley. Very punchy call from Lisa on chips. Ed Hosseini of Columbia Threadneedle joined us, and Nancy Lazar of Piper Sandler from New York City this morning. Good morning. This was Bloomberg Surveillance.